morning. I'm Julie Hyman alongside Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, Silicon Valley Bank Financial Group has filed for Chapter 11 bankruptcy protection, a move it says aims to preserve value. This as 11 banks offered $30 billion in aid to First Republic. Regulators say that move signals strength in the system, but the industry overall faces challenges from depositors, reminded perhaps of the risks of large uninsured balances. Second thing you need to know, we're wrapping up a wild week for the markets. Monday kicked off with regional bank woes following the failure of Silicon Valley and signature banks. Credit Suisse's Wednesday turmoil sparked fear of a more global contagion. And if that wasn't enough, we're closing out the week with quadruple witching. Remember, that's where index futures, index options, stock options, and stock futures, all of them expire. Usually, witching days trigger a flurry of trading that can mean big moves to the market. By the way, all that said, stock markets actually on pace to rise for the week, surprisingly enough. And third thing you need to know, FedEx boosts its forecast for the upcoming year. Although earnings declined for a second straight quarter, the delivery giant shares soared in after-hours trading as it announced plans to cut operating costs. FedEx has been struggling with sliding volumes, but offset that with price increases last quarter. Well, Silicon Valley Bank Financial Group has filed for Chapter 11 bankruptcy protection, with the company saying it believes it has $2 billion worth of liquidity. And this comes as the country's biggest bank swooped in to save First Republic Bank, or at least to try, with the firm set to receive a $30 billion lifeline from the likes of JP Chase, Bank of America, Wells Fargo, Citigroup, and Morgan Stanley, as well as 6 others. And by the way, that lifeline is coming, interestingly enough, in the form of deposits. Yeah. In other words, because a lot of folks are pulling their money out of First Republic, these banks are now putting money in. But we should probably start with now the SVB bankruptcy filing, which the company says in the filing is being done to preserve value of what is still left within the bank, the assets that are left there. I guess they couldn't find a buyer for these assets.
Right, and for Silicon Valley Bank and the entire week that has been, whether that be the action from the FDIC, Treasury, as well as the Federal Reserve, or even with this attempt for, in the fallout from some of the other regional banks, especially with regard to First Republic Bank, I think now we've seen swiftly how important many of these regional banks are for Silicon Valley Bank, whether it's because venture capitalists push some startups towards that bank or whether it's because some businesses opt for it themselves. It goes to show just how much of a role the regional banks play, especially in these startup phases of a company, because typically outside of those early family investments, outside of perhaps some angel investors out there, when you are looking for that loan, when you're looking for some type of capacity, even just to store the cash, the capital that you've been able to take on, you're often looking towards some of these regional banks if you are a startup, as opposed to some of the larger banks out there. But it becomes even more of an issue when you become a publicly traded company, for instance, and you're still holding so much of your funds significantly in a regional bank like Silicon Valley Bank. And with what you mentioned with First Republic Bank, it's interesting the deposits that were actually given up by some of those larger banks and the consortium of some of those regional banks as well, and PNC that I think of. But this is an uninsured deposit that they all put in to First Republic Bank. So Bank of America, Citigroup, JP Chase, Wells Fargo, all of them, $5 billion there. And then you've got BNC, PNC, State Street as well, putting in $2.5 billion in these uninsured deposits. Truist and U.S. Bank also making uninsured deposits of $1 billion towards this.
Yeah, and what's interesting is all of this coming together after the bank already got $70 billion in aid from JP Morgan and the Federal Reserve earlier in the week, and that did not serve to stem the losses. But guess what? This morning's deposits are not stemming the losses either. And our David Hollerith, who has been all over this story, has a really interesting one out on the Yahoo Finance platform now that sort of looks at how this latest rescue effort came together. It started, maybe not surprisingly, with Jamie Dimon being in Washington and wanting to speak with Janet Yellen about all of this, and then it sort of moved on from there. And you can read all about it again at yahoofinance.com. But the stock is still down 21%.
Right.
So now we have seen $100 billion go into First Republic in the form of this aid, and it hasn't seemed to help. And it's really interesting that there is still this sentiment disconnect here on this bank and on some of the other regional banks, right? Even if things, we've talked about this really as this crisis has been ongoing, even if everything is fine, from an actual asset basis, an actual operations basis, if people think it is not fine, then that becomes the self-fulfilling prophecy. Obviously, that's the threat of a bank run.
And what do, unfortunately, at this point in time, when you've got other stores of value, at least that's how it's been pitched in some of the cryptocurrencies out there. There is an overlap in how some regulators and lawmakers have talked about where some of these banks have placed some of their own interests in crypto as well. And then separately from that, as you have competing stores of value, as you know, of course, the historical makeup and instrument of a bank and that service has been for so many people, if there is a lapse in confidence in the bank system as the store of value, as being able to hold onto your cash and it being as liquid as it should be, and it has been for so long, then people start to think, okay, where is the safe store of value at the end of the day? And so that's what many of the banks swooping in here are trying to reinstill, as was really laid out in their statement: regional, mid-size, and small banks critical to health and functioning of our financial system.
Yeah, and I just wanted to take a beat here as we try to absorb the latest news, because it has been a week, right? It's not just been a week, it's been a month here. But with the collapse of Silicon Valley Bank unleashing chaos across the globe, then exacerbated by Credit Suisse, et cetera, I do want to go back and sort of go through the events that brought us here. On March 1st, remember, that's when Silvergate published a late notice and warned that there was going to be more trouble ahead. Then it said it was going to voluntarily liquidate on March 8th. At that point, there was not more sort of widespread issues, right, and concerns. But then Silicon Valley Bank said it was going to do a stock offering. That caused some head scratching. Why is it doing this stock offering? Then it was revealed that it was because it had some of these unrealized losses, and then very quickly got shut down last Friday. Over the weekend, of course, regulators getting together, trying to figure out what to do at the same time that they said that they were going to make those SVB depositors whole. At the same time, they announced the Signature Bank would be getting shut down. And also, First Republic got that first slice of liquidity support that I mentioned from JP Morgan and the Federal Reserve. So that all happening just in the span of like 3 days. Everything was just crunched together. We had some turmoil early in the week with First Republic and the other regional bank shares. But then on Wednesday, that's when we got the news that the Saudi National Bank would not be putting more money into Credit Suisse. So then we really had the migration of the concerns from regional banks in the U.S. and the banking system in the U.S. to the international banking system. Credit Suisse said it was going to potentially tap into that more than $50 billion lifeline from the Swiss National Bank. And then, of course, that brings us to today and this rescue of First Republic. And now, of course, we'll be adding another dot to that timeline, and that is the SVB bankruptcy filing. It just, and this timeline really throws into relief why this feels a little bit like the financial crisis. Again, just to emphasize, there's no indication that it is anywhere near the magnitude of the financial crisis, but it brings that echo back, because it is just, bump, 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 just one thing after the other, in terms of this compressed timeline of all of these failures sort of cascading. And
how if one thing or another did not happen during that timeline, and the swift action that we saw even between the 12th and the 13th, where you saw the consortium of the FDIC, the Treasury, and the Federal Reserve all have to do something at the end of the day. If there was nothing done, we were, of course, interviewing some of the startups, the small businesses, as well as the VCs that were present at a very thrills amid some chills type of conference, South by Southwest. And one of those founders, who wasn't directly connected to SVB, had told us that for a lot of the conversations he was having, people were concerned. The business leaders, the entrepreneurs, the CEOs that were banking with Silicon Valley Bank, they did not know if they were going to be able to access their money. They thought, and he put it as, Monday would be D-Day if something didn't happen. Now, we had spoken to him in the afternoon of Sunday. By Monday morning, we had a little bit more of an answer.
Yeah, exactly.
At least for the time being here, too. Also, let's break down this action this week and everything that has been, and discuss what's ahead with Baird Managing Director and Market Strategist Michael Antonelli. Michael, I think we just kind of take a sigh to start off this conversation. And now with that deep breath behind us, how do you even start to describe what took place this week and where we go from here?
I was kind of listening to you two, thinking to myself, is what we're going through right now unusual? Is this a moment in history where what we're seeing is kind of revolutionary or new? And I keep thinking back to the fact that, if you say we're in unprecedented times, you basically haven't read much history. And you guys might know this. There's been 70 bank failures in the past decade. There's been over 500 bank failures since the end of the GFC. So it's not like bank failures don't happen. Certainly the timeline that we've been through has been raucous, and it's kept all of us kind of glued to our screens and glued to watching you guys and glued to our terminals. But where we go from here is interesting. I will say that I think I'm calling this like a mini banking crisis. I don't think this is at the same level of the GFC. I agree with Julie on that. Is the mini banking crisis over? I think it's closer to ending than it is to beginning. The things that the government and the regulators are doing make sense to me. Ring fencing depositors make sense to me. I would even argue, my friends, that this might actually be helping the Fed a little bit. At the margins, is this mini banking crisis helping the Fed? It probably is, right? It's going to send a deflationary impulse through the economy. Credit conditions will tighten, lending will tighten. So they may not have wanted this to be one of the things that helped them, but I think this ultimately will help fight inflation, maybe much more so than a rate hike.
I mean, that makes sense to some extent. What I'm curious to ask, Mike, is why we are still seeing these regional banks under such pressure, even with all of these lifelines being thrown out.
It's a great question, Julie. I was thinking about my answer when you guys were talking about it. Here's what I keep coming back to. This is what markets do. Markets probe stress. And they will find it sometimes. They'll find the weak points and they'll drive into the weak points. Sometimes when they probe stress, they hit a roadblock and then that's it. But that's what's happening right now. Markets are going to probe stress until this moment has passed. And like you said, the actions of regulators and the Fed makes sense to me. The discount window lending makes sense to me. What these big banks are doing makes sense to me. It might be creating a feedback loop of big banks giving money to small banks, which ends up in big banks. But this is what markets do. They test stress, and we're still in that testing period.
Okay, and so with that in mind, I mean, a lot of people are just looking for any type of clearance or a sign to say that we are in the clear. What would that sign even look like if we have any indication?
It's probably going to come from credit markets. That would be my guess. I don't think it's going to come from equity markets. Equity markets can be crazy. The three of us realize that. Mm-hmm. I would probably be watching things like the 2-year note. I'd be watching things like high yield credit, maybe some of those credit default swap indices. Those are going to say when the funding stress, when the market stress is over, much quicker than, say, the stock of FRC or the stock of another regional bank or something. Those are going to still be probably volatile. So what I would be doing if I was an individual or if I was a professional, every day I look at the 2-year note. What is the market thinking about the Fed's near-term course? And then I look at some sort of credit index, whether it's HYG or LQD or some sort of credit index. That lets me know what the big markets are thinking about the stresses in the system. And then I do think weekends help. As weird as that sounds, weekends do help calm people down. Weekend headlines can help calm people down. So what I would do now, I would probably be looking at credit indices right now to really try to gauge what's happening in terms of stress.
Of course, the market's closed over the weekend, but banks aren't. So we'll see what happens with maybe some flows, deposit flows on Saturday. Just quickly, as we close out here, Mike, what are you going to be watching then going into next week? I know you said you're watching credit. I mean, is this a situation where you don't make any moves in the market until we know what's going to happen next, up to and including the Federal Reserve meeting next week?
So that is my number one thing to watch. Obviously, we want to see what they say. I think they're still going to hike. I would guess they're still going to hike 25. I don't think 50. Earnings, I've been watching earnings. Earnings estimates are still doing pretty well. 220 for the year, my friends. It's not like those are getting ratcheted much lower. So I'd watch earnings. I'd watch the FOMC. I'd watch certainly the headlines over the weekend. I'd want to continue to watch what some of the big banks are saying because they are part of this, system. They are part of helping their smaller brethren. So I'd be watching what they're saying. And it looks just a really weird time right now. Thank God it's St. Patrick's Day. I mean, at least we get that, right? Like, we do want to see, like, what does the close look like today? That is what I would say come back to Yahoo Finance at 3:59. What's the close doing? I think that's really going to be important today. It'll tell us a lot about people's views about going into the weekend.
Yeah, especially with all the witching action in between now and then, and that very big St. Patty's Day parade that's happening here in New York in just a couple hours.
Yeah.
Thanks so much, Mike. Good to see you. Baird Managing Director and Market Strategist Michael Antonelli. Appreciate your time this morning. FedEx shares are surging after the company delivered a beat on third quarter earnings and boosted its 2023 fiscal outlook. The delivery giant said it cut more costs this time around after earnings declined for the second straight quarter. It posted a slight miss on revenue and said it will reduce its headcount by 25,000 people by May. We'll get into all the details of FedEx earnings around 9:40 a.m. with Bank of America Senior Transportation Analyst Ken Hexter.
The understanding of what will happen or is happening to the U.S. banking system may take some time to untangle, but over the last few days, a clearer narrative has begun to come together on what has happened so far in this crisis. You can read all about this in today's Morning Brief over at the Yahoo Finance homepage, but for a deeper dive, let's welcome in the writer of the Morning Brief this morning, Ethan Wolf-Mann. Ethan, great to have you here with us today. All right, so help us dive further into your thesis here.
Well, I think it's really helpful for any time there's something that seems, or at least sounds complicated, to look at some charts. I think the data tell an interesting story here. And, kind of going through this, I selected 10 charts that I think makes this, clear for folks who maybe don't spend as much time looking at financial markets or banks or banking because it's boring to a lot of people. And sort of starting from the fact that, okay, this really began when the Fed started raising rates and how that started to affect things. And sort of, I keep coming back to this idea of a floodplain. As the rates rise, certain structures are exposed and, maybe don't have the structural integrity you'd like to see and, essentially get soaked, which is what happened. And so, looking at a few things I think were really helpful. Looking at how deposits grew in Silicon Valley Bank is really interesting. As you can see, things kind of went crazy. They were used to having things pretty calm. Look at the mid-2000 teens. And then really in the past 2 years, after the early COVID situation, they were just rolling in deposits as we had this tech boom. And they got a little over their skis, obviously. We heard on the Morning Brief earlier that Julie wrote how they had, actually, I don't know if it was Morning Brief, but Julie wrote an article about how, the risk in these bonds when you have a safe space to put treasuries, those may be really safe, which they are. We have a lot of people on Twitter talking about how, oh no, bonds aren't safe, the treasury, the US government thing, the thing that we all thought was safe wasn't safe. The credit risk is 100% fine. Clearly, we've learned that with all of the backstopping. But obviously, when you have a duration when these bonds or treasuries or, I think they're mortgage-backed securities are going to become, are going to mature a long time from now, that creates this duration risk. So these folks put all of the money, I think there's another chart in here, we have the rates going up and then the yield for the 10-year, let's say, also going up. So that price of the bonds went down. Again, not for any credit reason, but for this duration risk. And when a bank loses a lot of money, it ideally should have a lot of deposits, and that was something that it didn't have. Because as we saw in that earlier chart, when those deposits were really up from the past little tech boom, when this recent little tech snafu we've had over the past since November, let's say. The tech industry has been getting hammered. All of a sudden, these Silicon Valley companies, which use Silicon Valley Bank, were like, all right, well, we're gonna be needing that cash. We're gonna be taking that out. And I think it's really helpful to see exactly how they couldn't see that coming and see those projections. I mean, it's so clear in hindsight that that this was going to be a thing, but you sort of understand how they got it wrong. And had to use, the discount window, and things like that for all these other banks. I don't think the Silicon Valley used that, but another really interesting chart, which we came to, was companies that were exposed and why some banks are different than other banks. This is something that I think we don't think about that much, especially now, because as you walk into any bank, you see that that FDIC insurance limit, very lucky and good for you if you have more than that in your bank accounts. And obviously, a lot of these companies do, and they're over that insurance limit. And so that allows this level of exposure. And that was something that when you have, these niche, we were just talking about regional banks on the show. When you have these regional or niche banks, they may have a lot of this exposure. And that's something that, I don't know, until this week, I wasn't really thinking much about. And all of these, some of the banks that have the most exposure are the ones that we've been seeing, getting rocked to the markets, like First Republic and stuff. And so, right. You wonder about all these other companies that whether they're going to get their money back and whether that's going to spark more contagion. But things seem to have calmed down.
Ethan, our viewers can see the rest of the charts in the morning brief. Thanks so much for joining us to break down some of the most pressing ones that help make the case here. And as we continue to untangle the banking crisis happening in real time, mergers, acquisitions, or even breakups could be what face these banks. And our next guest says that the Credit Suisse company there needs a buyer. Credit Suisse needs a buyer. Let's welcome in Stephen Kelly, Yale School of Management Senior Research Associate. So why does Credit Suisse need a buyer?
Well, they need a new parent, basically, someone who the street trusts. So what we've seen over the last few months is sort of a slow bleed from Credit Suisse, right? They've lost employees all over the globe. Nobody's really trading with them anymore. Using their businesses to the extent they were. That was some of what we saw reported out of their latest quarterly numbers. Huge drops in trading through Credit Suisse, 96% in the case of equities. But now, just yesterday, BNP Paribas came out and said, we're no longer accepting, to be a counterpart to derivative trades with Credit Suisse. So that's the street starting to say, we no longer trust this entity to be around. This business model is not viable. They need a new parent, someone that comes in and says, we stand behind their contracts. We like the franchise value of the firm, and we're gonna adopt it into our structure.
I want to take a step back for a minute, Stephen, if you don't mind, because we are talking about really two different crises here when we talk about what's happened over the past couple of weeks. We're talking about, on the one hand, Signature, Silvergate, Silicon Valley, and their failures. And then we're talking about Credit Suisse and the sort of international banking system. You're somebody who studies banking systems, right, and systemic crises, potentially. How should we be thinking about? What's your framework for thinking about these two different situations?
Yeah, so this kind of goes to show how systemic risk is really a moment-dependent thing. I mean, we're talking about small banks in the U.S. that are causing problems, maybe globally, maybe contagion globally, and Credit Suisse has been bleeding for 4 months, and we really saw nothing. So this, Credit Suisse has sort of been a slow burn and could have been a test of the new international regulation regime. If it hadn't sort of been infected now with what's going on in the U.S., where we sort of stepped in for really what were small banks and said, look, this is a systemic risk. So we'll see how this plays out. I don't see really there's not really much connection between the two. The similarities are that these are business models that just don't look good anymore. Credit Suisse has shown over the last few years really how it's not very good at being a bank. Lots of scandals, lots of major losses. And this is kind of what we saw out of SVB and Signature too. They had business models that don't look viable into the intermediate future in a world with interest rates this high.
The other similarity is that this can net out in either fire sales or some type of consolidation in the sector. And so is that, from your perspective, a net positive or negative if we do have more consolidation of bigger banks going after smaller banks at extreme deal prices because they're just buying it for parts at that point?
Yeah, this is sort of one of the tensions in crisis fighting, I guess, which is that the best thing to do and what we know works is sort of an aggregation of balance sheets across the system. So what you don't want is one bank to fall and then you start worrying about the next bank and the next bank. So if you can sort of aggregate the banking system and say, look, the system as a whole is solvent, you can typically arrest the crisis. So what we see is that, in a crisis, we see more consolidation. And then after crisis, we see legislators complain about the degree of consolidation. So we'll see what lesson Congress learns from this. This should be sort of an endorsement of the big bank diversified model. We're seeing the big banks sort of come to the rescue of what's going on in California right now. But I could see them saying, look, big banks still aren't safe enough. Congress tends to love the small bank, the community banker, but they're more fragile. They're less diversified. And that should be the takeaway here.
They're more fragile, but people still probably shouldn't be pulling their money out. I mean, does the FDIC need to make do they need to make everything insured? Do they need to make all deposits insured?
Yeah, so this is something that they did in 2008, and they said system-wide uninsured transaction accounts are now insured, and Congress took this authority away. So again, deeply unpopular, rescue measure. Crisis fighter discretion tends to be really unpopular in the aftermath. But now the FDIC no longer has this authority until a bank is already in receivership. So that's why we saw it with SVB and with Signature. And that's probably why we got the systemic risk exception like we did, because the FDIC doesn't want to wait until a much, much bigger bank is in receivership to start being able to guarantee deposits. So this is a move for Congress right now. If it wants the FDIC to insure the system, Congress has to pass a law.
Well, let's hope we don't end up with a much bigger bank in receivership, that's for sure. Stephen Kelly, thanks for your perspective this morning. Yale School of Management Senior Research Associate Stephen Kelly. Coming up, Nvidia is getting an upgrade from Morgan Stanley, and we'll discuss why and have the opening bell on Wall Street. We're just a couple minutes till the opening bell right now, so we want to check on some movers here. Nvidia getting a bit of trading action this morning. The share's up by nearly 2% after Morgan Stanley upgraded the stock to overweight and raised its price target, saying that AI developments are outweighing any sort of persistent challenges for the company. $304 is the price target that they're putting on this. The company's GTC conference is coming next week. That's its big developer conference. And Nvidia tends to come out with new product announcements at that time. They've really been pounding the drum on AI, so safe to say we'll probably get some commentary around that.
Yeah, it was one of the biggest talking points on their earnings call when they announced that AI-specific cloud DGX and how that was going to layer on some models for their customers to be able to take advantage of. And for semiconductors in the landscape, it's seen more broadly a sector comeback over the course of this year. Now it's a bounce back off of the declines that we saw last year, of course, but up for at least SOX, which tracks the broader semiconductor ETF, or the semiconductor ETF is up by about 25% this year. So it's going to come on the back of everything from what they're talking about with artificial intelligence, how quickly that's going to be able to be deployed to a lot of their customers as well. But then additionally, just on ramping up the amount of capacity that's expected to come online over these next 2 to 3 years too.
Yeah, and just two quick observations I wanted wanted to make in the case of Nvidia, it's moving beyond hardware, beyond chips, to also offering services and software around it. And there we have the opening bell here, women in ETFs ringing the opening bell on this Friday morning. So that's one thing I want to mention about Nvidia specifically. The analyst at Morgan Stanley who made the call said, quote, there's a significant shift in cloud spending towards AI, even as budgets are under pressure. And that really emphasizes the other point I wanted to make, which is that we talk about AI as it relates to us as consumers and individuals very frequently. But there is now also a big movement of AI for enterprise. That's something we heard Adobe talk about in our interview with them yesterday. And that's something we're likely going to hear much more about from the tech world. Microsoft also making some announcements around enterprise AI as well. So that's something to note. All right, we got that opening bell. It's sponsored by Tasty Trade, our coverage of it. And we've got a little bit of a downdraft in stocks today. The NASDAQ off by about 0.1%. The NASDAQ, by the way, is up about 5% on the week, amazingly enough. The Dow has been the laggard on the week, but it's still positive on the week. And Brad, as we look at this lower open here this morning, just a reminder for our viewers, because it is witching day, the expirations of futures and options contracts, that tends to cause an uptick in volatility and volume, particularly at the open and the close. So expect some bouncing around today.
Yeah, keeping a close eye on the major averages to start things off here right now as I was just scrolling down to see what the VIX is doing. We can come back to that in a moment, but the Dow Jones Industrial Average, you're seeing that lower out the gate by about 0.5% right now. The NASDAQ Composite flat, just barely to the downside, is in the red though by about 0.1%. S&P 500, you're seeing that lower by about 0.25% right now. So all three U.S. major averages in the red as of this point in time. Let's take a look at some of the sector activity out of the gate as well. 11 S&P 500 sectors. We've got them all loaded up for you here on the screen. Only one gainer right now, and that is technology. It's up by about 0.2%. However, you've got 10 of the 11 S&P 500 sectors in negative territory. Financials, yeah, that's bringing up the caboose. It's been a rough, no good week for financials in the sector. It's down by about 1.5% right now. And here's a look at the week for you as well, down by about 4% over the past 5 days here. Also want to take a quick look at some of the crypto names that we're tracking. Those are the cryptocurrencies specifically, but here's some crypto stocks here. And I particularly wanted to pull up Marathon. Yes, Marathon Digital Holdings. That is moving higher this morning off of its earnings, the earnings report that it just put out. It's up by about 8% at this point in time. However, you've got some mixed activity, but largely in the green for some of those crypto stocks as well. We'll ride out with a look at the NASDAQ 100 also this morning. I had Coinbase up there on the screen for us.
And do we look at FRC? Yeah. What are we doing? All the way to the right.
Ooh, there we go. Okay, regional banks. Bingo.
Yeah, I'm just curious if we're still seeing as much of a drop even after this big infusion of deposits.
We are.
Oh,
yeah,
man.
it's
Look
down
at that
17%.
5-day chart. That's a record drop on the week, I believe, for FR. I mean, it would have to be, one would think. It's down 65%.
Yeah, it's down, so 65% over the course of the past 5 days, 16% out the gate here today. And I just want to take a look at this year-to-date move so we can put in context exactly what has transpired in this just in the last week, essentially. So.
Yeah, there really is this disconnect here, I think, because here we have all these deposits coming in from the 11 largest banks. We have the Fed, we have the FDIC, we have the Treasury effectively saying they're going to backstop, and yet still, you know, sentiment is not on First Republic's side. It's really a pretty extraordinary situation.
I think investors would have to be shown something material to say that there is some type of confidence that they should be placing.
I mean, it's right material now. When they get $30 billion.
Yeah, from the consortium of banks that stepped in as they did in the uninsured deposits. But again, people still a little weary on the trade, it seems right now.
For sure. Let's also talk about Warner Brothers Discovery. That stock is popping after upgrades from Wells Fargo and Wolfe Research. Wells is lifting its rating to overweight. Wolfe Research upgrading the stock to an outperform here this morning, and you can see obviously the shares are benefiting from it. And I'm just looking through the Wells Fargo call this morning and saying that they've been trending more positive on Warner Brothers Discovery because of synergies and execution. And they basically say that even though the macro environment doesn't look great right now, that the company is delevering and that it is doing well in this environment. So kind of interesting here.
This was a fun note to read. They said we threw everything in the kitchen sink at the downside case scenario. So they really tried to make the case for, all right, here's all the reasons why it should not be a bull case. And they still ended up with Warner Brothers Discovery delivering 3x growth by 2025. So they have conviction in the free cash flow limit to limit downside, while the stock has asymmetric upside, they're saying, and they have a $20 price target that they put on shares. As you're seeing there on the day, shares are sitting around $14.70 here. And with all of that in mind, they said their upgrade is predicated on de-risking the downside, but there are bullish themes, D2C, direct-to-consumer, and that content, and HBO currently undervalued versus the peers, given the near-term break-even and future profit ramp that they're seeing there. So that part of their bull case for Warner Brothers Discovery. Yeah. Also tracking shares of United States Steel Corporation, it's a fun ticker symbol, X, provides first quarter earnings guidance that top analyst estimates in parts to improving demand. Now you're taking a look at shares that were reflecting that moving to the upside here. And there you're looking at some of the targets that they also put out this morning here. They also, within this guidance, they expect to complete approximately $75 million worth of repurchases of common stock in the first quarter, and that is still under the existing $500 million stock buyback authorization as well. So 15% of their diluted shares are expected to have been repurchased since the beginning of December 2021, about $1.1 billion there.
It sounds like overall the first quarter guidance was much better than estimated. That's what we're hearing from analysts as well. Adjusted EBITDA going to be $375 million, which is about $70 million more than the average analyst estimate. And the adjusted earnings per share forecast is better than estimated too. Citi out in a note saying that the raised guidance is ahead of expectations and commentary from the company is constructive, that there's going to be some good momentum here. It's also interesting if you look at the broader supply chain, right, that this company is obviously getting back up online, even in what is maybe, what am I trying to say here? Steel is sort of an important measure of the environment, right? Of the economic environment, demand for steel. And so it's not just necessarily a good news for the company itself. Maybe it tells us something about the broader economy. Maybe, I don't know. Manufacturing hasn't been doing so hot.
Yeah, within this commentary that they did provide, you got two good notes in there and two mass. The good ones were in the mini mill segment. That's going to return to positive EBITDA in the first quarter. And then also in the tubular segment, that's expected to deliver its 10th quarter of consecutive EBITDA increases, healthy customer demand they're mentioning, and a value-added product miss. However, the two MAS were in Europe and then as well in their flat roll segment. So pay close attention to any results coming up forward in those segments as they report for the quarter, when they actually do put the real numbers out there. But this, an increase in the guidance.
Yes, exactly. All right, there's another stock we're watching. That's FedEx. It's getting a boost after raising its outlook. We're going to speak with an analyst from Bank of America as that stock surges almost 10%. FedEx is getting a boost from investors after the company raised its outlook and said its cost-cutting efforts led to positive expansion for its ground and freight segments. The shipping giant also announced it would slash its U.S. headcount by 25,000 in May. It had talked about that headcount reduction. Now we have more of a timeline. Bank of America's senior transportation analyst Ken Oxter joins us now. Ken, thanks for being here. FedEx has really been trying to right the ship here. Where does it feel like we are in that journey?
So great. Good morning, Brad and Julia. I'd say that we're really just at the start. I think that, if you go back a year ago when they hosted their analyst day and they talked about how they were going to do $7 billion of cost adjustments, $1 billion this year, about $4 billion between 23 and 25, and then $2 billion thereafter. These were almost pie in the sky type of numbers, just because that's about $21 of additional earnings on what then was about a $15 base. So you think about the magnitude of what they in, and then they first quarter out of the box, they missed. So now we're actually starting to see tangible evidence. You mentioned the 25,000 employees. Only a couple months ago, we were looking for 12,000. So, that could be almost $1 billion right there of just getting to that employee level. So now that you're putting some concrete facts behind the numbers, it becomes more real. So I think we're just at the beginning of kind of taking off on this cost-cutting program, and that surety of confidence that you get as they do each of those steps keeps building to get to the ultimate target.
So as FedEx gets better about managing its own expenses, should businesses that they engage with, end customers that are relying on their services, should they expect their prices to come down?
So I don't think you see prices come down. I think what you see is service improve, right? They talked about the average time of delivery going from 2.3 days a year ago to now 2 days. So you're actually improving the service. And I think that there's a price for that. And what you want to do is you want to charge for that. And I think you're going to see core pricing go up. Now, the printed pricing, the yields that we actually see are likely going to come down just because fuel surcharges roll over, and that's a direct pass through. So the printed price that we see on a yield basis may come down on a year-over-year basis, but the actual pure pricing that FedEx and UPS continue to recognize should go up and cover your inflationary costs.
Well, I was going to ask about it versus UPS and the pricing dynamic, Ken, because, at what point, especially as we maybe start to see the economy deteriorate, do we see more of price competition? I mean, how comparable are they in pricing right now? And at what point are we going to have to see pricing come down in that scenario?
Well, I think you're pricing to the market. You're pricing to the service you're providing. So if you're improving service, you're trying to get a better return on that product. You're likely to see, again, like I said, pure pricing continue to stay up. They've had general rate increases that continue to pass through. And in an inflationary environment, you want to cover those rising costs. Remember, FedEx right now has, as much of the cost-cutting program we're talking about, printed a 1% margin at Express. They did do just about 9% at Ground. That's well below UPS, which is up at about 13% right now. So FedEx has, they were mismanaged a year ago, and for the past 2 years, they're trying to come back with some cost cutting, some new management team, and work on that. So this is not about cutting pricing to win volumes. In a down market, that just decreases everybody's margins. You're looking at a market as I'd say a duopolistic structure, but you still then have the post office, you have Amazon out there as competitors. But again, right now, we're not seeing them chase to the bottom by using price. We're seeing them work to recover the cost of inflation by increasing pricing.
How exposed is FedEx compared to its competitors to some of the macroeconomic challenges that regions internationally, like Europe, are facing?
Absolutely. These are the most concurrent economically exposed companies in the transport world. Rails and trucks tend to be leading. Air freight tends to be mostly concurrent. So you're seeing that with the volumes, right? Volumes were down close to double digits on the Express side. But what you're looking for in the monthly data, it actually was getting less negative. That's a good sign. If you look at the slides from FedEx, each month through the quarter got a little bit less negative. That might mean we've passed some of the worst. But you're right; they are very concurrent economically. In Europe, also seeing that weakness. But also they just finished blending TNT and FedEx Europe together last May. And so now it's all going to be about going in and upselling that and growing the business in a part of the business that had lost a lot of share. So for FedEx, that's all about recovery in Europe. we're going to hear a lot about that at their April 5th Drive Analyst Day, talking about the recovery and the potential in Europe.
All right, and we know that you will most likely be present, or at least just listening, even very close. Bank of America Senior Transportation Analyst Ken Hexter. Ken, thanks for the time.
Thanks for having me.
You got it. Guys, coming up, Sanofi is now the latest healthcare company to cut its insulin prices. Yahoo Finance's Anjali Khemlani has the details next.
We told you at the top of the show about Silicon Valley Bank financial group filing for Chapter 11 bankruptcy protection. I just wanted to offer a little bit of clarification on that. This is the parent company. It is SVB Financial Group that has done this bankruptcy filing. The bank itself, the commercial bank that is, where most of the deposits were held, the vast majority were held, is under the receivership, the control of the FDIC. So it is not part of this bankruptcy filing. And also it sounds like that the operating arms of the securities and venture capital businesses are also not part of this filing. It sounds like it is just the holding company here that did this bankruptcy filing. So just to clarify there, because the filing was not the clearest. So I wanted to make sure that you understood as we came to understand what exactly that filing meant. Brad?
Sanofi becoming one of the latest major drug companies to slash insulin prices, capping the cost at $35 after facing pressure from lawmakers. Yahoo Finance's Anjali Khemlani has the details on this one for us. Anjali.
That's right, Brad. As you mentioned, Sanofi joining the top three drug insulin makers, including Novo Nordisk and Eli Lilly, the latter of which led the pack on this movement, slashing prices by 70% or more on most of their top selling products. That includes short-acting as well as long-acting insulin types, and that's just a little bit of detail there. But Sanofi has offered that this will take place, cutting the price by 70% and capping out-of-pocket costs for commercially insured individuals at $35 by January 1st of next year. That follows suit of what Novo Nordisk also offered, cutting its insulin price by 75% and also putting into place a 65% cut on another drug, another insulin, also by January 1st. Eli Lilly has been a little bit more aggressive. We saw them offering to cut their insulin prices by between 70 and 75%, as well as getting all of that in place by April or May of this year, including a pricing of $92 per 5-pack of a biosimilar to one of Sanofi's products. So all told, all of that detailed information just to say that they're really responding to what happened in the Inflation Reduction Act with Medicare now capping out-of-pocket costs at $35. This has now become across the board. Many of these companies did take action early on, especially late last year. We saw a little bit of that reduction, especially for uninsured individuals. Some offered that $35 out-of-pocket cap or a savings card, but this is really just the biggest move across the board for that.
Yeah, and just to emphasize that real quickly, this is something that people who depend on insulin to stay alive have been pushing for years, right?
Yes.
And so this is a big deal.
This is a huge deal. And this is something that not only do these individuals rely on to stay alive, they rely on it daily, twice daily in some cases. And there's such a large mix of products that we're talking about here. So that's why it's so interesting. And the real big impact is the fact that you're talking about, maybe 30 products in total that have this now across the board $35 out of pocket.
Yeah, it's pretty remarkable. Thanks, Anj. Appreciate it. Coming up, Google is upping the price of YouTube TV as it juggles content costs. Our Ali Canal will have the details next. YouTube TV announced it's raising its monthly subscription price. This comes as content costs are rising and the streaming service continues to invest in quality. Yahoo Finance's Ali Canal joins us now to break it all down. I guess quality's in the eye of the beholder, but
yes. Yeah, prices are rising. You're going to pay $8 more, about 30% from the previous price of $64.99. Now it's going to cost you $72.99. This is the first price increase in 3 years.
Wait, this is monthly?
This is monthly.
This is how much YouTube TV costs?
Oh, yes, it
30
is.
days. Yep.
But Julie, look at that original price. In 2017, when YouTube TV first launched, it was $35. So now we are more than double that at this point.
What
Outraged.
No, what are you paying for? Like, what do you get with YouTube TV?
I
had no idea it was so expensive.
The big thing for YouTube TV is sports. I think that is what they are leaning into right now. They just won the exclusive rights to NFL Sunday Ticket at the end of last year. The terms of that deal were not disclosed, but the New York Times had a report saying YouTube TV was willing to pay $2.5 billion for this package. They beat out a lot of competitors, including tech giant Apple, which reportedly backed out of the deal. So I think they're really heavily focusing in on sports. They're testing a new multi-view option where sports fans can pre-select 4 games and watch all 4 games at the same time, which we know is a very attractive option for those sports enthusiasts. So I think they're really creating this niche around sports. Analysts have said, look, this is not going to be a profitable service for YouTube TV. It's ultimately going to be a loss leader, but they're at a point where they are trying to lure in subscribers as fast as they can, and they have the backing of Google, which of course, can afford to spend $2.5 billion on a sports package, whereas a streamer like Netflix cannot. So I think that is what we're seeing here. It's going to be a long-term play for YouTube TV, but of course that comes with higher prices for consumers.
I am hard-pressed to know one YouTube TV title. I don't know any of them. I
like
mean,
original program?
Like an original program.
So my brother has a YouTube TV. I share his account. They're very open to sharing accounts.
You're messing up his algorithm.
Of course, but I do it for the live sports option. If I want to watch my Eagles,
Yes.
I can't watch that if the Giants are on at the same time. YouTube TV kind of allows you, the Sunday Ticket will allow you those types of options.
Okay.
So I think for me, it's the live sports. They're not really focused on original content. So they're trying more to go into that live element.
You said the magic word for me, which was Eagles access over all of the other in-market games that I have to watch in New York City.
How do you watch the Eagles now? You go to a bar and watch the Eagles?
Well, either I go to a bar and watch the Eagles, yes, or I have to wait for one of their nationally broadcast games.
It's a pain.
It sucks.
And
actually.
I think Sunday Ticket is going to be actually very beneficial for YouTube because of that, for my own personal experience.
At what point does it become once again competitive with cable?
Well, that is a big question right now. A lot of these media executives, we just had the Paramount CFO on earlier this week, they're all preaching that at the end of the day, streaming still provides value for consumers. However, I received many angry emails, many angry tweets about all of these price hikes, and consumers do say that they are cutting down on their subscriptions.
Yeah.
So it's inevitable that we're going to see consolidation over the next few years. I think right now, all of these companies are just rushing to try and prove their value, prove their worth to the consumers. We've seen Paramount really lean on franchises, Netflix lean on their original content, Disney lean on their IP. We'll see, though, who comes out on top.
Yeah, I'm just negotiating differently with my family and friends about who gets what access.
Exactly. I mean, the password sharing crackdown, it's coming. I'm very scared about that for Netflix. Okay. I'm like to my mom, who are you going to pick? Me? My brother?
Wow.
Who's going to be the 2 extra people? Who's your favorite?
Find out who is the real favorite child. Yahoo Finance's
Stay tuned.
own Ali Canal. Thanks so much, Ali. Appreciate it. Guys, coming up, we're going to get a pulse check on how consumers are feeling about the economy with some new data. You don't want to miss it. Welcome back to Yahoo Finance Live, everyone. I'm Brad Smith alongside Julie Hyman. We've struck the top of the 10 a.m. hour here on this Friday. Happy St. Paddy's Day out there. Over to the major averages right now. Let's take a look at the Dow. The S&P 500 and the NASDAQ were mixed. The Dow down by about 0.5%. S&P 500 lower by about 0.2 or 0.2%, sitting right in between there on the declines. And then additionally, the NASDAQ composite, you're seeing that higher by about 0.3% right now. Now on over to Julie with some breaking news.
Yeah, we got University of Michigan consumer confidence, the preliminary reading for March, and it's not good. 63.4 is the reading. 67 is what economists were anticipating. Current conditions have come way down to 66.4. Expectations also have come down to 61.5. Inflation expectations have also come down, however. One-year inflation expectations in this report, 3.8%. It was 4.1% last time. And the 5 to 10-year inflation expectations part of this, where do consumers think inflation is going over the next 5 to 10 years? 2.8% versus the 2.9% previously. What's interesting about this is, and I don't know what the survey period is, I'll have to look into that, but obviously we've had a lot going on in the markets over the past couple of weeks, and you have to wonder if some of that has started to bleed in here. I mean, if you rewind, and it's hard to even rewind before last, like Thursday, Friday, but we were, of course, talking about the Federal Reserve getting sort of more aggressive here, or more hawkish, before it was going to pause. We got hot inflation readings. And so maybe this is somewhat reflective of that, of inflation remaining persistent, of the outlook for the Fed. Again, it's hard to know if this is incorporating what's been going on. But what's in the report there?
Yeah, in the report, it's saying that the sentiment declines were actually concentrated among lower income, less educated, younger consumers, as well as consumers with the top tercile of stock holdings. Now, here's where it gets interesting. Overall, all components of the index, they worsened relatively evenly, and this was primarily on the basis of persistently high prices, creating a downward momentum for sentiment leading into the financial turmoil that began last week. That from the survey of consumers director Joanne Hsu, and the year ahead inflation expectations, they receded from about 4.1% in February to 3.8%. That is the lowest reading since April of 2021, but it's still well above kind of this 2.3% to 3% range seen in the 2 years prior to the pandemic also.
Yeah. Let's turn back to the situation with Silicon Valley Bank, because the sudden failure of the bank was a wake-up call for startup tech companies, exposing pitfalls in the financing arena. Here to examine the impact on the relationship between the tech and banking industry and the effect on Silicon Valley culture is Single Store CEO Raj Verma, along with Techstars CEO Maël Gavet. And just to explain to folks, Single Store, database company, a startup company. Well, at one point it was a startup company, a little more mature now. Techstars does seed funding, just to give a little bit of context for folks. And Raj, I want to start with you. You actually put an ad in the Wall Street Journal, sort of, I guess, touting the idea of Silicon Valley as one that has value still, right? And that's as it's gotten a lot of flack. So, you know, there is this disconnect seemingly right now between how people are viewing Silicon Valley and how it views itself. Maybe that's not new, but what kind of message do you want to put out there about that?
Yeah, as I said, by the way, it's a pleasure to be here. It's sort of early in the morning. We were just hit by a storm, so we were out of electricity for 3 days. Of course, the valley needed all of that with what was going on. Last week was not a very pleasurable week. You know, everything happened so fast. A lot of us, actually, almost all of us, were very surprised at the speed at which things happened. And naturally, I don't blame anyone when, you know, there is a dark cloud over the valley and the tech industry. However, you know, for us entrepreneurs and founders and all the rest of it, we were going about doing our job the way we were supposed to. And we were just completely blindsided. Now, the fact really is that SVB as a bank was a great partner to us right through, and ultimately ended up in a really good place. And I just wanted to, you know, show gratitude towards what the Valley has afforded me and my family and my colleagues. I doubt if there is a place in the world that would have given an immigrant like me and a lot of immigrants who are my colleagues and friends the chances that this Valley has afforded us. It is it's a wonderful, wonderful place where innovation thrives. And I do think that the best days of the Valley are ahead of us.
And so, we certainly do hope that those best days are still ahead of us. Even with that in mind, Mael, I wonder, for so many of the stories like Raj's, where you've got a radical impact to how businesses can see themselves through the next week, the next month, and so forth, and are just continuing to look for answers here, how much of your portfolio and the clients that you have as well are impacted by this?
Thank you first for having me on today. This is a very pivotal moment in our lifetime for the future of the global technology ecosystem and startups. So to answer your question directly, we have 3,500 companies in our portfolio. They are from all around the world. We invested in companies like ClassPass, Chainalysis, SendGrid, and we work with a little over 24,000 investors who have at one point or another invested in a Techstars portfolio company. So we're decently plugged into the ecosystem. It is very clear that Silicon Valley Bank challenge that happened over the weekend impacted a lot of the startups in the tech ecosystem, and it's primarily due to the fact that, number one, with the boom in tech startup investment and the growth at all cost mentality, we created a world where unprofitable startup needed to constantly fundraise and required continuous lines of credit. Number two, SVB was basically the only one to support tech startups with the required lines of credit. And then on top of that, things got worse because of the herd mentality and the fear of missing out, which is very prevalent among VCs. And so you combine all of that, and the majority of startups around the United States, the numbers are a little over 50%, were in one way or another impacted by what happened with SVB last weekend.
It feels like, and you in a LinkedIn post offer some helpful advice to some of those startups, Mael. But you also, as you also just mentioned, VCs are a big part of this culture. And Raj, I want to take this to you, and I actually want to read something that Elizabeth Spears wrote in the New York Times in an opinion piece when she looks at this. And she was somebody who banked with SVB as well. She says, the venture capitalists chose a path that would be disastrous for their industry, talking about the reaction to SVB, freezing up capital, spooking investors, and reducing the favored financial institution to rubble. Then they had the temerity to go on social media and congratulate one another for their quick thinking. Raj, is VC culture... you talked about all the good things about the Valley. Not everything is good about the Valley, right? Is VC culture a big problem now going forward? Does this expose some of the downsides that go with it?
Yeah, I think there is some truth in the fact that some of the friends led to the demise of SVB. There's just no ifs, ands, and buts about it. If he had wanted to engineer a bank run, you couldn't have done it better than what transpired last weekend. Look, I mean, VCs there are hundreds and thousands of VCs in the Valley. Most of them that I meet are extremely cerebral, extremely trustworthy, and really, really good individuals. And I do think that some of them did spook the companies and led to the bank run where, what was it, $42 billion got taken out of the bank on Thursday. And I think they were pending wires for $36 billion. Now, the fact of the matter is no bank could ever survive that. So I do think there is a lesson to be learned. However, we do have to realize that it's the same VC community that's probably created the greatest wealth in the 50-mile area between San Jose and San Francisco.
But at what cost, Raj? I mean, those are the VCs, it seems to me, with the most power. And I want, Mael, maybe I'll take this to you if I can. Does the balance of power in the VC community need to change? I mean, there's also been a lot of criticism of VCs for funneling cash into the same old folks. And thankfully, you two are exceptions, but into white Ivy League educated startups, for example.
Yes, so as I was mentioning earlier, there is a fundamental issue with the way VC generally operates. Many VC, not all of them. I would want to start by saying there are some exceptional VCs out there who do a tremendous job to help startups and the tech ecosystem globally. But many VC hunt as a pack. They're terrified of missing out on the next big things. And as a result, they funnel money to startup, which would likely never be profitable. And they perpetuate, as we discussed earlier, they perpetuate the need to constantly fundraise because they need to justify their investment by ever-growing valuation. What is likely going to happen as a result of the last 6 to 9 months with the valuation going down and what happened over the weekend with SVB is that the VC ecosystem is actually most likely going to change in terms of the type of company they're going to go after, change in terms of consolidation of the VC themselves. We expect at Techstars that between 30 and 50% of the VC that exists right now are going to become what we call zombie VC, which is VC who are still managing their previous fund, but are not raising new fund. And so we expect to see a lot of changes and hopefully for the good.
The broader market environment, though, and economically and how VCs are managing the capital that they do deploy to some of these startups, that pendulum had already started to change because of their own kind of scrutinous cost management in this near-term period of time. So how much more does the collapse of Silvergate, the broader banking issues that have become known over the past couple days and weeks, how much more does that continue to move that pendulum back towards just companies that have a solid pathway to profitability? And how do we ensure that some of the new investments that these VCs have made into more diverse startups, whether that be in the entrepreneurs and the CEOs, the people leading that, or the types of businesses, how do we make sure that that doesn't get left by the wayside?
I think to start with, we need to accept the fact that winter is here for the tech ecosystem. And the reality is that it's going to be a long, cold winter for many companies. And we're going to see a lot of startup fail. We're going to see VC undergo a massive consolidation. We should expect higher regulatory scrutiny and Silicon Valley to be under a microscope more than ever. And we should expect founder to have to relearn what it means to build a financially sustainable business. Having said that, I also think that it's not all doom and gloom. There are some bright spots ahead. If you look at investing in early stage, this is a stage that has historically been very reasonably priced, and it continues to be so. There are, as we speak, incredible companies right now which are creating solutions that we so desperately need to solve society's biggest problem, whether it's health tech, climate tech, food tech, fintech. And there are a lot of really safe and stable companies that have crucial infrastructure for their industry, like Chainalysis that I mentioned earlier. And there is money. The big VC have raised multi-billion-dollar funds. Big capital allocator institutionals have now created a VC box for their investment. So there is money, there is amazing entrepreneurs, there are big problems that they're working on. And so I would want people to have a positive view, nevertheless, on what's going on.
And I want to bring it back to that for you too, Raj, because that's kind of where we started with this, again, ad that you put in the journal where you talked about Silicon Valley as an idea and an ideal, if you will. So where do you think we go from here? Do you think sort of a new class of leaders emerges here to push startup culture in the tech industry to the next phase?
Yeah, I do think that there is a learning from all of this, Julie, for sure. There is absolutely no doubt about that. I do think that I'm a lot more optimistic about the Valley than probably another person. I do feel that there was a lot of exuberance, I must confess, in 2021, where there were a lot of valuations which weren't justified. I do think that, founders and entrepreneurs focusing on the fundamentals of business, which really haven't changed. Essentially, you spend less than, you sell, and everything else is going to be fine. From our perspective, just a shout out for the VCs that we've partnered with. We've always gotten a lot of encouragement from them to manage our cash well. In fact, one of the reasons why we had a reasonable weekend compared to some of the others, well, we were one of the companies that was actually talking about treasury management 7 months ago after we had raised a big pile of money. We also had multiple bank accounts. So just fiduciary duties of keeping your capital safe, which was something that a lot of the founders and the entrepreneurs in the Valley did not do. So yes, I think what doesn't kill you makes you better. So we do feel that there would be stronger companies emerging at the back of that. I do think there will be greater governance, especially around cash management in companies that will happen as a consequence. And I do think that innovation would continue to thrive here.
Balance sheet management, spending less than you sell. It shouldn't be so unique a concept, Raj. Thanks so much for being here. Raj Verma, Single Store CEO, and Maël Gave, CEO of Techstars. Thank you both so much for this conversation. Really interesting one.
Thank you.
Coming up, in the wake of SVB's collapse, why government bailouts may be getting a bad rap. Yahoo Finance's Rick Newman's got a take next.
We've been in Austin, Texas, here for South by Southwest, evaluating all things that the city has to offer: good music, good barbecue, and of course, a lot of technology, folks. Here's one thing that you need to know about South by Southwest if you are looking for a vibe check today. Everyone is speaking about what the future looks like for artificial intelligence. There's deal making happening here. And yes, there are a few good parties. We can talk about that because let's be real, they're happening. But all of that aside, the vibe has been good. Everyone is trying to figure out what is the next technology that's not just going to be profitable in the future, but perhaps change our everyday lives. We've had the opportunity to speak with the mayor of Austin, Texas, who gave us a little bit of insight into how this city is competing with Silicon Valley through its own version they call Silicon Hills.
There's a reference to our beautiful hills west of Austin here. Silicon Hills continues to grow and it continues to expand in different ways.
There's a lot of things that make Austin weird, and they're trying to keep Austin weird. Oh yeah, that's the slogan, you betcha. But we've also spoke to Eve Air Mobility. We spoke to Icon 3D. They're printing 3D homes. You're going to drastically cut down the costs for homeowners by 2 to 3 times, they say. What you need to take away from this is everybody in some form or another is trying to figure out where artificial intelligence plays a role in their business model. And a lot of that artificial intelligence conversation, it should be reframed as augmented intelligence. If you were to ask chess master, grand chess master, Gary Kasparov, and the chief product officer over at Shutterstock, who is also going to be incorporating this into their business. If you wonder why, the companies of mega cap techs are plastered all over the skylines here with their logos of Indeed, of Google, of Silicon Labs. Here's why. It's because that they believe Austin is staying weird enough for them to get innovative and freaky with the technology in the future. And that's what you can count on your everyday life, perhaps being changed as a result of something that comes out of Austin, Texas in the near future, and perhaps because of one of the deals that's happened here in 2023 at South by Southwest.
Let's do a quick check of the market, sponsored by Tasty Trade. We see all 3 major averages in the red right now. Once again, as we've seen all week, the Dow is leading to the downside, off about 1%. It might not escape this week higher, but the other 2 major averages look like they will. Taking a look at some other things that we are watching here in these markets, I want to look at bond yields. This is something we have been watching so closely, right? Because we have really seen a collapse in bond yields after the past week and a half or so. So now we've got the 10-year yield below 3.5%. Very recently, all of the yield curve was above 4%. So this is really a reflection of expectations that the Fed will not move as aggressively in the wake of these bank collapses. And speaking of those bank collapses, got to take a look at how some of the banks are trading again at this moment. We continue to have shares of FRC that are trading lower by some 12%. First Republic Bank here trading sharply lower even after that $30 billion deposit infusion from 11 banks. Now the shares are down 66% over the past week alone. It keeps getting halted for volatility at various points during the session. It's been that way all week. And we've got PacWest that is still trading lower as well, but down 17% on the week, down another 11% or so in today's session. The large banks, as well as we've been watching them, are all also uniformly in the red in today's session. The NASDAQ 100, this has been one of the weird offshoots of this week, is that tech has been the safe area by comparison, right? That we have seen this money go back into large cap tech because it's seen as a place that is a haven, oddly, in this environment, which is a bit unusual here to see, or a bit counterintuitive, I should say, to see. Nvidia right here in the middle of your screen up 2.5% on the back of an analyst call today. Brad?
Amid the collapse of the Silicon Valley Bank and, of course, with the impending moves that we've seen and Signature Bank, mixed opinions have emerged surrounding the government's rescue of the two lenders. But Yahoo Finance's Rick Newman says bailouts are getting a bad rap. He joins us now. Rick, break it down for us.
Hey, guys. Well, you're hearing all these pro-capitalist guys like hedge fund operators and others like that say, oh, this is a violation of the rules of capitalism. It bails out people for taking risks who should have known better. That's all true, but I think what everybody's forgetting is that capitalism in the United States exists within a political system, and it's just an imperative that the president is pretty much always going to sign off on the type of bailouts we've seen during the last 2 weeks when there are jobs at stake, which there were in this case because of all the companies that would have lost money, and when there's disruption to ordinary people, which also would have happened. So Biden is coming under heat from Republicans for doing this bailout, as if it would have been the more prudent thing to do to just let these two banks fail and see where the chaos leads. If we had a Republican president would have done exactly the same thing, not because anybody wants to do a bailout, because it's just politically imperative. So for all the capitalists who say this shouldn't have happened, I think the capitalists have to remember this happens inside a political system that demands action. And that's why we have the action that we have seen. And we will see more of that if it's necessary. I'll just add, banks have such a bad rap because of the way they were done in 2008 and 2009. But the huge bailouts of the whole financial system back then actually tell us how not to do it and how to do it. And Biden actually has the chance here to build a better bailout based on what we have learned from 2008 and 2009. And so far, I think that's actually sort of happening.
Well, and that's a really interesting point, because as our David Hollerith lays out in his writing on yahoofinance.com as well, you know, Jamie Dimon is somebody who sort of spearheaded this latest deposit infusion into First Republic. And he has said repeatedly and publicly, like, he didn't want to buy Bear Stearns. And in retrospect, he wished that JP Morgan didn't have to do that. So this time around, you are getting quote unquote bailouts, but they don't involve ownership. They don't involve, at least in the case of SVB, a bailout of the equity holders or credit holders of these institutions. So it is different this time. I mean, in terms of the reaction.
It's very different. So I think there are two things worth pointing out. The way the private sector banks themselves are getting involved in these bailouts is very different. The model up until now was the FDIC or other regulators would find a big bank to buy the busted bank, which is what Jamie Dimon was referring to. And he bought, JP Morgan Chase bought Bear Stearns. They also bought some other banks. And then he ended up not really liking those deals because of all the trouble they involved. So now it's happening different. We're not seeing a single bank buy the busted bank. We're seeing basically a consortium of banks that are getting together to help out First Republic. And who knows if that is repeatable, but that is a different model. The other thing here, I mean, I think the most important lesson from the 2008 bank bailouts, remember TARP, the Troubled Assets Relief Program, that was a big part of it. Those bailouts did not put adequate conditions on the banks. So one of the huge controversies after those bailouts was that the banks went ahead and paid executives these giant bonuses as if it was business as usual. And it created the impression that taxpayer money was paying bankers who caused the financial crisis millions of dollars in bonuses. I mean, that was obviously horrible optics, but the whole thing happened so fast that nobody really thought about that ahead of time. So important when you do a bailout is the bankers, the people in charge of the banks that fail, they need to feel some pain. And at least in the case of these two banks, they are feeling some pain. So they did hold a lot of the stock. The stock is gone. It's zeroed out. So that's a scalp right there if you prefer. And we also saw some reports of some of these executives actually selling shares before the banks went under. Now, that does not automatically mean it's insider trading, but boy, if it is insider trading, I think you're going to see prosecutors go to town on that because they want justice, especially after what happened in 2008 and 2009.
Yeah, most definitely. Lots of good points there. While we have you, Rick, Chinese President Xi Jinping is set to visit Russia next week. It's his first meeting since Vladimir Putin invaded Ukraine, and we just learned that this visit is going to be happening and when. What does this tell us about this sort of global realignment?
I mean, the hugest question for Ukraine and for the United States and all of Ukraine's allies is to what extent is China going to help Russia in the war itself? Now, China has been doing a lot more trade with Russia. They have been buying more Russian energy products because it's harder for Russia to sell those elsewhere. I don't think that the United States and Ukraine's allies are terribly concerned about just basic trade between the two countries. I think they are extremely concerned about the prospect for China actually helping Russia with things like weapons. That would be a big deal. And we've already heard warnings from the US government that China may be considering that, and they better not do it. So President Xi Jinping, it's not clear yet whether he's going to meet with Vladimir Putin, the Russian president. I think almost surely he will. Otherwise, why would he be going? So there will probably be some statement of unity between these two countries. But I think then the question becomes, is this just optics, or is there really some deepening partnership that could help Russia with the war in Ukraine? We will find out. Lots of eyes on that for sure.
Yes, most definitely. Thanks, Rick. Appreciate it.
See you guys.
Coming up, why our next guest says the banking crisis is not over. We'll speak with former Home Depot CEO Bob Nardelli. That's next. We are wrapping up a wild week for the banking industry. It's not done, and is the worst of the crisis behind us? Not according to our next guest. We're joined by Bob Nardelli, founder of Accelerate LLC and former Home Depot and Chrysler CEO, and Yahoo Finance's executive editor, Brian Sozzi, hanging out with us as well. Bob, thank you so much for being here. It's great to have your perspective after all your years in business on what is going on right now. So you don't think we're at the end of the crisis? I mean, the way First Republic is trading today, it doesn't feel like it. Where are we in the process, and how do we figure out what happens next?
Yeah. Well, thanks, Julie and Brian, for having me on this morning. The reason I would say that is I know we heard Secretary of Treasury say that the banks are now solid and there'll be no additional issue when we heard from SVP. But that's the same office that said inflation was transitory. And so, I look at this with a little bit of a jaundiced eye. I had a number of companies involved in the SVP situation where there were large distributions that were going to be made that got frozen. Now, fortunately, those were released to the investors in that fund, not necessarily in the bank. And then we've seen First Republic, which you've been advertising or talking about. We heard about Credit Suisse also having financial problems now, and it just seems to be cascading. I lived through the 07, 8, and 9 that you've been talking about and Rick was talking about earlier. And the issue there is we were focused on just the financial meltdown. And as reported from my experience, many banks were forced to buy insolvent banks and pick up those assets. Some put tremendous strain on Bank of America, for example, on JP Morgan with Jamie Dimon and so forth. So I just think we have to be very, very careful here. What we're seeing is, as you would expect, depositors are very concerned about having their money frozen in some of these regional and community banks. So I'm not surprised that we're seeing this thing kind of cascade and waterfall down to some of the other banks. One could argue whether what took place to save SVP and some of these others was right or wrong, but I don't think from a consumer standpoint, a depositor standpoint, there was any choice, and we had to bring some confidence level to the overall banking system and the depositors out there, Julie.
Bob, as someone that managed through the prior crisis, do you view this current situation as a crisis?
Here's what I think is significantly different. When I was running Chrysler, we were somewhat singularly focused on the banking situation that started to melt down. It caused a tremendous amount of pressure on the auto industry, for example. I got a call at 9 o'clock one night and said, Bob, you cannot do any more lease arrangements. And that was 60% of my business, for example, in Canada. But we were singularly focused on the financial banking crisis. Today, Brian, what I think we're facing is the extent with which a CEO has to manage today is as broad and deep as I've ever seen it. I've been at this for 52 years now. And when you think about inflation, you think about supply chain, you think about the loss of labor, you think about massive resignation and so forth. So the breadth of constituents that a CEO and a company has to try and satisfy, again, is as broad and as deep as I've ever seen it. And when you try to satisfy everyone, you end up satisfying no one. So the banking situation just adds another level of complexity. Now, if you adhere to the black swan theory, you try to prevent or put in place remedial actions to prevent that. But what we're seeing today, I mean, who went to bed Thursday night thinking that their deposits were going to be frozen on Friday, right? So it is the certainty of uncertainty that we're having to deal with today in the business community. Now, on the bank situation itself, what concerns me is how did certain investors become aware to pull $42 billion out on Thursday? What was the whisper, or how did they pick up on that? How is it that the bank employees got paid and many of the entrepreneurs and the startup companies couldn't make payroll because their accounts were frozen? So there seemed to be some potential inequity there. I don't know. but it's just on the surface would raise some eyebrows, I think, Brian.
Bob, you mentioned going back to the last crisis, tightening lending standards. We're now seeing signs that might be playing out now. Are we at or just on the cusp of those conditions sending us into recession?
I think we are definitely on the cusp of that, potentially. We went through this period where there was plenty of investment dollars. And so they were spread across a number of startups, and you hope 1 out of 10 was big enough to cover the losses on the other 9, and you'd have a home run. I think that people are now looking at it with a much more jaundiced eye and making sure that the money they're putting out there today has a higher probability of success. So, and we know that some of the entrepreneurs and startup companies suffered dramatically during this period, and we're seeing it cascade down, as I said. And so I think there may be some dampening of the spirit of starting some of these companies or being able to provide additional funds. I mean, we all know people are going out now asking for additional funding in a Series A, B, or C, D round. And I think there may be some concern about that. Unfortunately, we may not see the same level of entrepreneurship and new innovations coming out as a result of this thing, Brian. And so it remains to be seen. You had 2 experts on earlier on your program talking about that, and I think I would support some of their comments. Yes.
And Bob, as someone who, and I remember very vividly reporting on the crisis as it was unfolding in 2008, 2009. As someone who has worked through that one, and now you're living through this one, I'm curious that, I'm sure you talk to other executives, other investors. Can you give us sort of we like to do vibe checks here on Yahoo Finance. What's the sort of concern level now versus then? Are you having people who are freaking out, for lack of a better word, now versus then?
Well, I would say just during that crisis, what's happening now is cash is king, liquidity is king. I was just on a call this morning with one of our companies and really drilling down to make sure that we've got cash preservation, that we're really looking at every dollar that's critical to maintain liquidity in our company during this pressure. There was already a lot of movement there as a result of inflation. What were we doing? How were we managing supply chain? How were we going to make sure that we had the right labor mix because of some of the situation that were going on? Labor rates were going up. We saw all of these issues that were having a compound effect on the ability to run a business and to run a business profitably. So you can imagine 7, 8, and 9, we were burning about $1 billion a month at Chrysler. And so we were having cash council meetings every morning, reviewing commitments, not reviewing what bills we had to pay, but let's make sure we're conserving cash relative to the commitments we're making to order supplies, et cetera, et cetera. And I see that now more and more. You can imagine some of the private equity funds that I work with that had money in the SVP bank were very, very nervous over the weekend until they got confirmation that there was going to be this funding. I don't want to use the word bailout, the funding that took place to be able to keep running that business, to make the distributions to the investors in that fund, not investors in the bank. And I think you're going to see a real swing now for more intensity on cash preservation and liquidity. We saw that in the market, right? We saw a shift from growth stocks to dividend stocks. As you reported earlier, Julie, about some of the tech things up, all the banks are under pressure from what I saw on your board when you were reviewing that just a few minutes ago. So I think there is going to be somewhat of a pullback. People are going to want to see the whites of the eyes before they start spending frivolously on things or taking maybe reducing the degree of risk that they're willing to take during this period of time.
Bob, good to get your perspective this morning. Thanks for joining us. Our thanks to Bob Nardelli and Saz for sitting in as well.
Thank you.
Coming up, we'll speak with the CEO of First Watch Restaurants after the company reported its new units were breaking sales records. That's coming up.
Taking a quick look at the major averages as we are a little over an hour into today's trading session. The Dow, the S&P 500, and the NASDAQ are all in the red. Take a look at the Dow, down by nearly 400 points right now, 1.25% in the red. You've also got the S&P 500 now down by a little more than 1%. And the NASDAQ composite, that's down by about 0.8%, about 90 points as of this point in time. We'll keep a close eye on this. As one of our guests mentioned early on in the show, this is the activity that's going to be key to track going into the weekend to really get a sense of where some of the concerns that have come into the fray over the course of this week, especially in financials, where that may permeate even into next week's trading activity as well. Switching gears, First Watch Restaurant Group. They reported a Q4 loss earlier in March. Still, the daytime restaurant chain added 43 restaurants in 2022 and is looking to add as many as 51 more despite the expected economic slowdown. For more on the company's Q4 results and growth outlook, let's get to First Watch Group CEO Chris Tomaso. Chris, great to have you here with us today. All right, so talk to us about the plan to continue expanding even though there is some uncertainty in the economic scenario right now.
Yeah, there's certainly some uncertainty, but we've seen our consumer be extremely resilient throughout, COVID and beyond, and to where we are now. And so we feel good about our continued growth. We have a plan. We're sticking to it. It does make forecasting a little bit difficult with the environment that we're in right now, but we had a tremendously strong 2022, a great fourth quarter. And, we've been the fastest growing full service restaurant company in America for the last couple of years. And we expect to continue that pace.
Chris, this might be a silly question. Why to what do you attribute that speed of growth here, especially for folks who are not familiar with First Watch?
Yeah, and we recognize that there's a lot of folks not familiar with us, even though we're coming up on 500 restaurants in 29 states. We've been a high growth concept for many, many years. We know we've flown under the radar somewhat in the restaurant industry. I think it's our unique offering to start with. We're a breakfast, brunch, and lunch only concept. We're open from 7 a.m. to 2:30 p.m. There's really nobody out there doing what we're doing. And brunch and breakfast has been not only the only segment in the restaurant space that's been growing, but it's been doing that for many years, despite about 70% of breakfast occasions still being eaten at home. So a tremendous growth opportunity for us, a lot of white space. We've identified the ability to open 2,200 restaurants in the U.S., and this is just part of our plan to get there.
Have you had to modify any of the ingredients that you use in the menu items that you have across the store and restaurant footprint?
No, we offer the same menu across our entire system. Our entire menu is available all day long, from when we open to when we close. We have a lot of third shift employees, for example, that come into us at 7 a.m. when their shift is over, and that's their lunchtime. And and they can get soup, salad, or sandwiches at that time. And of course, our brunch and breakfast menus available the entire time as well. But one thing about us is we approach everything from a position of freshness. So we don't have heat lamps, deep fryers, or microwaves in our restaurants. We use, all natural chicken, organic greens, cage-free eggs, things that consumers are seeking in their dining choices today. And so we've been, a culinarily forward concept for a very long time. And we just think we're perfectly aligned with the way the consumer is moving and has been for a while on how they want to dine.
Chris, as a restaurant chain, you guys have an advantage that I think many consumers would want right now, which is you guys have a fixed price contract for your eggs that you talked about in your most recent conference call. Eggs finally have started to come down a little bit in price, but I imagine that's been an advantage. But have you been able to, you got that fixed price, but have you been able to get the supply that you have wanted over the past 6 months or so? I'm sure you guys use a lot of eggs in the restaurants.
We use a tremendous amount of eggs, and last year was an especially volatile year for that, as the consumer knows. But the outbreaks of avian flu that occurred last year really put a lot of strain and pressure on the egg supply. Look, our first objective is to ensure that we have supply, and so we did experience some volatility last year, obviously. And going into this year, we were able to contract our eggs and potatoes from one of our, and that represents about 15% of our market basket. And so it really is more about ensuring the supply than it really was about pricing.
All right, we're all about the eggs here.
We
Thanks
really
so
are.
much, Chris Tomaso, First Watch Restaurant Group CEO. We appreciate the time here today. We'd love to check back in the future as well. And guys,
anytime. Thanks for having me.
Sounds good. Guys, coming up, we're going to speak with former FDIC Chair William Isaac on what's to come for big banks after a tumultuous week. There, William is, we'll see in a second.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC. The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within 1 business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Silicon Valley Bank's holding company filed for Chapter 11 bankruptcy protection this morning, just 1 week after the FDIC's takeover of the collapsed bank. Joining us with his thoughts on SVB's sudden meltdown and the government's response is William Isaac, former chair of the FDIC. William, thanks for joining us here this morning. First and foremost, if you were to kind of encapsulate everything that's taken place and the response that we've seen thus far, how would you explain this? Just give us your perspective on it.
That's a big question. Let me take a shot at it. We've been a long period of time with not very much fiscal responsibility or monetary responsibility at the federal level, and the federal debt has grown massively from about 5.5 trillion at the end of the Clinton administration to 30 trillion plus today. In addition, we've had a lot of monetary buildup. The Fed's balance sheet has now got $9 trillion of debt. When Paul Volcker was chairman, it never went over 800 billion. So there's been a lot of money pumped into the economy, and we have inflation. And inflation is something we've got to bring to a halt. Jay Powell has been doing that, and trying belatedly. The Fed should have been doing it years ago, but he's been putting the brakes on and trying to raise, not trying to raise interest rates, but trying to reduce inflation. And the way you do that is you raise interest rates, and that reduces economic activity and brings prices down over the long haul. That's just essential, and so that was what was going on. Has been going on. Just as Jay Powell was getting ready to do that, Silicon Valley Bank started buying massive amounts of government debt and keeping them on the balance sheet, fixed rate. And that was I guess something that they thought they were hedging, but it was a terrible mistake. It's not the first time that mistake has been made. It was made in 1979 when Paul Volcker was chairman of the Fed and I was at the FDIC. First Pennsylvania, the largest bank in Pennsylvania, and reportedly a good bank, decided to make a heavy bet on investing in U.S. Treasuries. They did, and they lost because Volcker started raising interest rates. The value of those Treasury securities went down. The bank was insolvent, and we had to deal with it. Silicon Valley Bank's actions here were irresponsible. I don't know how they could have made that bet in good faith, but they did, and they lost. And it's really too bad that this has caused all these problems to be stirred up. This is something that has happened before. It's been punished before, and why they had to do it again, I don't know.
Bill, do you think that the cap on uninsured deposits, or the cap on insured deposits, I should say, needs to go up?
I don't think it needs to go up. When I went to the FDIC in 1978, the cap was 40,000. During the S&L and banking crises of the 1980s, which were massive, the Congress raised that cap to 100,000. And the FDIC was lukewarm at best about raising that cap, but the Congress did it. And then I think in the 2008-2009 period, it was raised again to 250,000. I don't think it needs to go up. I think that's a lot of money. The FDIC was supposed to protect ordinary depositors,
right?
And it wasn't supposed to protect fat cat investors at Silicon Valley Bank.
Well, I think there was probably a mix of them in there. I just quickly want to squeeze in one more question, but before we run out of time, you did tell Politico that there was no doubt in your mind that there would be more bank collapses. It's been an eventful week. Do you still think that is the case?
Oh, there already has been.
Right.
So
do you think there'll be more from? Do you think there'll be more from here?
Yes, but people need to be calm. The federal government, the Fed, the FDIC, and even the Congress, if need be, have a lot of power to deal with things. I hope we don't overdo our concerns. But an example: Silicon Valley Bank and the bank in New York, Signature Bank, that went down. Both of them, they were aberrations. They're not normal banks. They were strange banks, investment banks of sorts, and they were not run like ordinary banks. And if you add them up together, they're $300 billion. That sounds like a lot of money, but it really isn't. It's a small percentage of the U.S. economy, which I think is something like the banking system, something like $23 trillion, something like that. And so we really have reacted very strongly, and I think too strongly, to what's going on so far. There could be more failures, and I'm not going to predict there aren't any, but I don't see anything that we can't handle fairly easily in this country. We've got a lot of wealth. What I'm more concerned about is that the federal debt is way out of control, massively out of control, and the monetary policies have been far too liberal, and we need to fix that. Those are serious long-term issues that the U.S. has got to get its hands around.
Bill, got to leave it there. Thanks for your time. FDIC, former FDIC Chair Bill Isaac, appreciate your perspective. Thank you.
Thank you.
Well, coming up, Anjali Kamlani is going to speak to Moderna's president as that company gears up to face Senator Bernie Sanders next week over its vaccine developments and pricing. You don't want to miss that. Rochelle Akuvo has you for the next hour of trading. That does it for Brad and I on this Friday as we see stocks decline. And we leave you here. Rochelle's got you from here. Stocks down at the lows of the session.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akuvo. Here's a look at what I'm watching this hour. Big banks to the rescue. 11 banks step in to save First Republic after another chaotic week for financials. Investors, though, continue to fear the spread of contagion. We'll speak to one analyst who says the crisis is far from over. Plus, are the best days of Silicon Valley over? Venture capitalists facing stark criticism after the collapse of Silicon Valley Bank. What happens next, and where do we go from here? But first, let's get a check on how the major averages are faring. We're seeing some major selling off here continuing. All three major indices at the session lows at the moment. The Dow there off about 430 points, about 1 1/3%. The S&P 500 also down about 47 points on the day, about 1.2%. Tech-heavy Nasdaq there at least getting the least of the brunt of this, down just shy of 1% there, down 100 points on the day. Let's also check in on the Treasury market as we continue to see this flight to safety in bonds, especially in short terms. So as you see there, the 5-year down about just over 6% there. The 10-year down 5% on the day. And of course, the longer term yields seeing a bit less pressure there, down 2.85% on the day. Well, the banking sector has been grabbing the headlines this week as it navigates through several hurdles, including the collapse of multiple US banks. Now, we're taking a look down memory lane on all the key moments leading up to the current frazzled state of the banking sector in this week's installment of What Just Happened. Now, it begins with Silicon Valley Bank when it proposed selling stock to raise additional capital, leading to clients pulling their money from the bank out of fear as depositors tried to withdraw $42 billion from the institution. Then Treasury Secretary Janet Yellen addressed the Silicon Valley turmoil on March 10th over concerns of SVB.
There are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
However, Yellen making note when convening with financial regulators that the banking system remains resilient. At the same day, Silicon Valley was seized by regulators along with Signature Bank over the same weekend, in which regulators said a systemic risk exception, which allows the government to pay back uninsured depositors. At the start of the week, SVB depositors were given access to their money, followed by investigations opening the next day on SVB's collapse. And in the midst of the fallout of SVB in the US, overseas fears began bubbling over Credit Suisse. Now, the worries of the Swiss bank's viability sent both regional and big bank stocks tumbling once again, with shares of First Republic taking the worst beating, dropping 60% on March 13th. The Treasury Secretary Janet Yellen once again reassuring the safety of the banking system in yesterday's remarks.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
It wasn't long before First Republic was given a lifeline, receiving $30 billion in deposits from other banks, while Credit Suisse is set to receive a $54 billion loan from the Swiss Central Bank. However, the fallout of Silicon Valley Bank continues as its parent company files for Chapter 11 bankruptcy. Well, to get into all the latest unraveling for the banks, we have Johan Schultz, Morningstar Holland BV equity analyst. Quite the roller coaster of a week it's been. I want to first start with what we're now seeing with the market reaction. Obviously, we saw yesterday some optimism there as we got these liquidity injections for the banks. A different story today, though. What are the investors digesting today?
Yes, so I think what we're seeing for European banks, at least, and Credit Suisse specifically, today, markets probably trying to figure out, okay, we've hopefully removed the risk of Credit Suisse going to zero for the time being, but what would an ongoing Credit Suisse actually be worth? So I think that's what we're seeing with everything with Credit Suisse today, pressure on its share price again, and I think it's very, very important that we get some kind of clarity sooner rather than later about what the ongoing structure for Credit Suisse are going to look like. What exactly will Credit Suisse look like going forward? We actually do believe that Credit Suisse still needs some restructuring, and that restructuring should entail a ring fencing of the investment bank that has been at the core of a lot of Credit Suisse's problems, winding down that investment bank. But the challenge for Credit Suisse is really going to be to find the funding to actually pay for that restructuring.
And to that point, you said in your note that the current restructuring plan does not go far enough. We've seen that Credit Suisse lost about a fifth of its value just this week. What is the best and worst case scenario for Credit Suisse at this point?
Yes, I think the best case scenario would probably be a situation where you're really going to end up with a Credit Suisse that is just going to consist of the Swiss bank, which is really a normal retail and commercial bank, plus quite a substantial private banking business. And as I said, you need to ring fence the investment bank. And then to pay for the wind down of the investment bank, Credit Suisse will probably have to sell its asset management business and its wealth management business. Now, what it would be able to extract, what kind of value it would be able to extract for those businesses would remain to be seen, because unfortunately they will be seen as forced sellers. Worst case for scenario for Credit Suisse would probably still be not necessarily a out and out collapse of the bank, but the bank being wound down with bondholders getting bailed in. That is, however, I think the ultimate bear case scenario, and it's definitely not our base case scenario.
And you mentioned some of the healthier parts of the business potentially getting listed or sold off. What are you looking at perhaps in terms of prospective buyers?
Yeah, I think the name that obviously always crops up is UBS. I think there are some challenges for UBS to be a buyer of these businesses. While they're very complementary, I believe, to UBS's business. Firstly, it's maybe a bit too complementary. So, for instance, if you merge the Swiss retail bank of Credit Suisse with UBS's retail bank, you end up with a very concentrated market share in the Swiss market, which is probably not something that the regulator would like. The other challenge would be that the Swiss regulator, always have maintained that, it's already challenging for them to support two large global banks like UBS and Credit Suisse. Now, if you combine that into one, the sort of too big to fail problem becomes even larger for the regulator. And then lastly, the challenge would be, there's been reports that UBS is not all that keen on taking over all of Credit Suisse, but that might also just be them playing hardball and trying to extract a better deal should it get to a situation where UBS needs to take over big chunks of Credit Suisse's business. Other buyers, Deutsche Bank also springs to mind for the wealth management business of Credit Suisse. I think there's a lot of European banks, maybe even some US banks that would be looking to cherry pick some of the higher quality assets of the Credit Suisse's balance sheet.
And Johan, obviously with the timing, you had the ECB that was debating whether or not to focus on financial stability versus tackling inflation. They went with the 50 basis point hike. Looking at the Fed, though, with its own separate issues here, trying to prioritize financial stability, what are your expectations for the Fed meeting? How heavily do you think they'll prioritize it at their next meeting?
Yes, unfortunately, I have to pass on that question. I'm not an expert on US monetary policy at all. I was quite happy to see the ECB, however, actually maintaining their path in terms of interest rates. I think it actually supported the banking sector. European banks are geared towards, positively geared towards higher interest rates. And I think it would actually have sent a negative signal to the market if they paused with interest rates. It would really have admitted to markets that, we've actually got a crisis on our hands.
And we know that messaging very important, especially with so much uncertainty in the markets right now. Johan Scholz, thank you so much for joining me this morning. Well, the banking sector turmoil is putting the Fed in a bind as the fallout of Silicon Valley Bank continues, with its parent company SVB Financial filing for Chapter 11 bankruptcy protection. Now, here to discuss all this and more is Samantha Leduc. Leduc, trading founder. Good to see you, Samantha. So the question on everybody's mind, because of course, we thought we were in relatively good shape with investors yesterday. A different story today. Is the bank run over?
It's definitely the biggest question on many people's mind. Is the bank run over, and do we have a credible backstop? I think short term, yes. We've had the promise, if you will, Fed, Treasury, White House Sunday evening. and that has slowed the fear and the contagion. But longer term, no. I think it's pretty clear that this is a symptom of this commingling of fiscal and monetary, the commingling of Treasury and Fed that is actually very undermining to financial stability. So they did step in to stem the deposit outflows and to backstop literally. It's not QE, but it's definitely kind of the promise or the implicit QE, and the monetary framework is very loose with that. So tech loves it, Bitcoin loves it, gold loves looser monetary policy. So it's a little confusing because we are having this kind of melt up in the momentum space, but bigger picture, it is not sustainable long term.
So then as we look at the implications for this emergency lending program and what we're seeing with the Fed's balance sheet as well, how should investors be positioning themselves then, given that there still is this outstanding risk?
The risk is basically going to be whack-a-mole, right? So they're going to have areas of more disruption, if you will, in the unrealized losses that come to bear when a bank or insurance company or other needs to recognize it, another financial institution needs to recognize it. So it's really the promise of unlimited backstops. That's not sustainable. So right now, banks didn't take so much of the facility that was offered, the BTFP, and they definitely have stemmed this confidence crisis in the immediate crisis, but it does not negate the fact that it's unsustainable U.S. government debt. And right now, the market very much trades inversely with this this flow of backstopping, and tech and semis and gold obviously are smelling that loose monetary policy. But there is now the question, all eyes on the Fed. I really think that this is going to be very tough for them. They're trapped. Fed is trapped, if you will. They can't raise too aggressively. Luckily, inflation is decelerating month over month since its peak in June at 9.1. It's now CPI came in at 6%, but it's still too warm. The economy is still too warm. A lot of the lagging impulse from these higher rates hasn't really been felt yet in the economy. So that is putting them in a tough spot. Can't pause or pivot. Can't hike more aggressively. It looks very much like the short end of the rates are done going up. And there has been a lot of FOMO to basically capture that yield in those short duration T-bills, because they have reversed very strongly lower. And I think that's going to continue. The short end is actually going to continue to fall. So as it relates to advice that I gave my clients even before this bank failure, not just confidence, but pricing, was very much a deflation impulse. So my recommendation was prior, actually the past month, to short reflation trades, which happened to be banks before knowing that there was going to be a crisis, as well as metals and mining and energy. And we've had a strong pullback in energy, oil and gas companies of late, but especially crude. Down to my $65 price target. So I think that that's more of an implication of deflation of assets, even though tech is acting like a bond proxy right now and rising very sharply with gold in light of this loosened monetary policy to try and backstop the bank run.
And I mean, this really does open the door on this conversation about moral hazard. We saw that Senator James Lankford went back and forth with U.S. Treasury Secretary Janet Yellen, and that was part of her testimony this week. Take a listen. I want to get your reaction.
Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk.
Now, there is the potential for sort of moving goalposts here. I want to get your take on what's your reaction to that?
I think the Silicon Valley Bank failure is very much a testimony to failed monetary policy in that the risk-free the risk-free assets adopted by these financial institutions, both, by the way, here and abroad, is this quasi-deficit financing of U.S. government debt. And it's a mismatch. So this duration risk mismatch, it's fine until it has to be recorded. For example, in the case of Silicon Valley Bank, where they had to realize those losses, and that's what threatens financial stability. That's not done. That problem is huge. So this is the risk to both equity and bondholders that forced the Fed's hand in the first place to backstop with their implicit pivot. So it's an implicit Fed pivot, but we're not at a point of an actual pivot because that would, the economy's still running, strong enough to sustain maybe one more 25 basis point rate hike in the next FOMC meetings next week. But I still think that this is a quintessential case of Fed is trapped. So hike too high, things start to break. We've already seen that happen. And that's first banks and then credit lending. Then it translates into consumer jobs and spending. So hike too little and inflation, expectations move higher. So I think right now this is an implicit Fed pivot and the market is smelling that, hence why gold is higher, bonds as well with tech. I think the equity market, however, will start to pull forward that recession risk that this causes, and we're not out of, this is not risk-free anymore.
Certainly hard for the Fed to be both the problem and the solution at the same time. Samantha Leduc there, thank you so much for joining me this morning. All right, coming up, has advancing artificial intelligence surpassed the importance of the metaverse to CEO Mark Zuckerberg? We discuss next.
We've been in Austin, Texas, here for South by Southwest, evaluating all things that the city has to offer: good music, good barbecue, and of course, a lot of technology, folks. Here's one thing that you need to know about South by Southwest if you are looking for a vibe check today. Everyone is speaking about what the future looks like for artificial intelligence. There's deal making happening here. And yes, there are a few good parties. We can talk about that because let's be real, they're happening. But all of that aside, the vibe has been good. Everyone is trying to figure out what is the next technology that's not just going to be profitable in the future, but perhaps change our everyday lives. We've had the opportunity to speak with the mayor of Austin, Texas, who gave us a little bit of insight into how this city is competing with Silicon Valley through its own version they call Silicon Hills.
There's a reference to our beautiful hills west of Austin here. Silicon Hills continues to grow and it continues to expand and in different ways.
There's a lot of things that make Austin weird, and they're trying to keep Austin weird. Oh yeah, that's the slogan, you betcha. But we've also spoke to Eve Air Mobility. We spoke to Icon 3D. They're printing 3D homes. You're gonna drastically cut down the costs for homeowners by 2 to 3 times, they say. What you need to take away from this is everybody in some form or another is trying to figure out where artificial intelligence plays a role in their business model. And a lot of that artificial intelligence conversation, it should be reframed as augmented intelligence if you were to ask chess master, grand chess master, Gary Kasparov, and the chief product officer over at Shutterstock, who is also going to be incorporating this into their business. If you wonder why, the companies of mega cap techs are plastered all over the skylines here with their logos of Indeed, of Google, of Silicon Labs. Here's why. It's because that they believe Austin is staying weird enough for them to get innovative and freaky with the technology in the future. And that's what you can count on your everyday life, perhaps being changed as a result of something that comes out of Austin, Texas in the near future, and perhaps because of one of the deals that's happened here in 2023 at South by Southwest.
Facebook parent Meta announced that it will lay off another 10,000 employees earlier this week. Zuckerberg also sending a clear message to both Silicon Valley and Wall Street that artificial intelligence is now as important to the company as the metaverse. Yahoo Finance's Dan Howley has the details on this one. Hey, Dan.
That's right, Michelle. When you look at what Mark Zuckerberg said when he was announcing these layoffs, these 10,000 workers, which, by the way, some found out today and yesterday, Others will have to wait until the end of the year. So not a great strategy there if you're looking to boost morale, but I digress. I think one of the things that you should look at is what he was saying between the lines. And one of the big things, if you notice, is that when he mentioned the metaverse, before he mentioned that, each time he mentioned artificial intelligence. So when he was discussing growing the company or looking for new places to improve, he said, we're going to be building out AI as well as our work on the metaverse. Now, okay, that could be me just reading too closely into things. But if you also look at their Q4 end of year quarter transcript, he does the same thing, talking about AI before the metaverse. Now, what does this all mean? Well, it's a signal from Mark Zuckerberg and Meta that the company is putting a lot of emphasis on AI at a time when it's hot. Now, part of that is because, look, we had ChatGPT, we have Bing, we have Google. All of those are really pushing the AI discussion. A lot of companies are now jumping on that hype train saying, oh, look, we're adding ChatGPT to this, that, and the other thing. The other thing, though, is that the metaverse is unpopular with investors. Zuckerberg and Meta, spent $10 billion on it in 2021 and then $13.7 billion on it in 2022. So he's plowing money into this. Investors obviously not happy. We had seen Meta's stock basically fall apart last year. It's picked up again this year. Could be because it was at rock bottom prices comparatively, but it's also because of this discussion where they're pulling back seemingly on their overbroad discussion of the metaverse and now saying, no, look, we're focused on AI. We're going to be using AI. We have a new AI unit was something that Zuckerberg had announced. We're making sure that we have the proper AI tools to compete with the likes of TikTok, which relies heavily on AI for its algorithm that gets everybody so hooked. So this is something that they're going to continue to do moving forward. It doesn't mean that the metaverse plan is going away. It means that they're working on a way to continue to make money that they can then use to subsidize the work on the metaverse. Now, it's clear that the AI side will likely pay off sooner than the metaverse side. That could take years, maybe into the 2030s, before we actually see any real action from Meta as far as getting money from the metaverse. But for now, it looks like AI is taking the lead over that to make sure that Meta has the is in Wall Street's good graces.
It certainly makes sense as they have this year of efficiency trying to streamline that focus more towards AI as well. A big thank you there, our very own Dan Howley. All right, checking in on markets here, sponsored by Tasty Trade. That selling action continuing here. The Dow off more than 430 points now, about 1 1/3%. The S&P also down about 1 1/3%. Both of those being dragged down by financials. We're seeing those are down, the sector action. Financials down about 3.25% on the day. Tech-heavy NASDAQ at least getting the least of the brunt, but still down about 1% on the day or 124 points. All right, coming up, the path to crypto regulation runs through the SEC. We speak with Coinbase's head of public policy about what they can expect in terms of regulatory framework coming this year. Stick around.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC. The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within 1 business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Cryptocurrencies resumed their rally on Friday, climbing above 26,000 for the second time this week for Bitcoin. Now, for more cryptocurrency and the path to regulations in the United States, we welcome Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Thanks, Rochelle. SEC Chair Gary Gensler has repeatedly called on crypto firms to come in and register with the commission and come into compliance with securities laws. Back in December, I asked Chair Gensler why it's been taking so long for crypto firms to get registered. Here's what he had to say.
It really is on these entrepreneurs and business leaders in the crypto space. And it's an area that has grown up worldwide with a lot of intermingling of customer funds on their platforms, providing interest returns to their customers, and then trading against their customers and the like.
I put this to Coinbase's Chief Policy Officer, Faryar Shirzad, and asked whether Coinbase has attempted to register with the SEC and what their experience has been. We also talked about coming into compliance and forthcoming crypto legislation. Here's what he had to say.
There's no path to registering. We've tried, and there's just no way to do it. And in fact, we've submitted a petition with the SEC back in June where we enumerated the specific issues that the agency would have to resolve for crypto platforms to be able to come in and register. We think the opportunity to build a crypto securities market in the United States is enormously exciting, but we've stayed away from it because there's no path to registration and there's just no way to do it.
When you say there's no path to registration and you've submitted a petition, has the SEC responded to you?
No, unfortunately, they haven't. And you know, Jennifer, I know you've had the chair on, you've had other SEC officials on. I'd encourage you to ask them when they say come in and register, when they say download a document from the website, ask them register as what? In what capacity? How is it that under current rules you can't trade tokenized instruments under a national stock exchange or an ATS? Will the SEC address that in some fashion? There's a huge opportunity for the agency to engage in a public notice and comment process where everybody, the agency, stakeholders, industry, can all come in and share views on how we get to a path to creating a crypto securities market in the United States. But until that happens, there's just no way to get there.
And you've tried to follow up. In other words, SEC Chair Gensler said it's on the exchanges. He says he wants to get crypto firms to come into compliance this year. But when you've tried to follow up, you haven't heard anything back. Is that correct?
Well, we talked to all the regulators. So we talked to the CFTC, the state regulators, the Treasury, the CFTC, you name it. We talked to all of them, including the SEC. But when we ask specific questions, how do we get to a path to registration? There's never an answer.
Faryar, in an amicus brief that Coinbase filed on Monday, Coinbase says that the digital assets that currently trade on your exchange are not securities. You would like to talk to the SEC, obviously, so that you can begin trading securities. My question is, why is it that the assets that currently trade on your exchange are not securities? Why do they not meet that so-called Howey test that the SEC uses?
Well, there's a four-part test known as the Howey test, which is the best guidance that we have. So it's about a 70-year-old Supreme Court decision that enumerated four factors that you essentially would apply to determine whether a particular contract is an investment contract and therefore treated under the 1933 and 1934 Acts as a security and therefore requiring SEC registration. So it's quite complicated. But we review the four factors of the Howey test, apply them towards each token, and if we feel like it's too close to the line, then we just don't list it.
I want to ask you about the custody rule that the SEC has put forth in terms of extending that to apply to crypto. You put out a statement stating that Coinbase is a qualified custodian. Has the SEC put its stamp of approval on that?
Well, the SEC put out to its credit, actually, we've been asking for rulemaking in all sorts of aspects of crypto markets. This is an area that impacts us where there was actually a rulemaking. And so the agency put out a proposed rule. And under the terms of the proposal that the agency put out, it's clear that our custody entity, CCTC, is a qualified custodian. And we're confident that as the rule gets finalized, it'll remain a qualified custodian. So we feel quite good about that.
Mm-hmm. And I want to ask you also, Coinbase CEO Brian Armstrong tweeted recently, he was hearing rumors that the SEC would like to get rid of crypto staking. I put that question to the SEC. The SEC says that they regulate conduct, not industries. Of course, we saw what happened with Kraken. Are you hearing anything new from the SEC on the staking front?
No, I mean, like with everything that comes out of the SEC, we have to parse through the information that's available to try to connect the dots to see whether there's an element of what they've said that applies to us. We've looked at the Kraken settlement quite closely, compared it to our own staking offering, and it's very different. Our staking offering is not a security. We essentially provide a pass-through service to anybody who can do staking on their own should they choose to, but instead ask us to do it for them. So we do the staking, the protocol decides what the returns are and the terms under which the staking event takes place. We charge a fee, a transparent fee that's known ahead of time on top of that. So we're providing a fee for a service, and it's far from it being a security. And we're very confident that if necessary, we'd be able to defend it quite effectively.
Of course, I know that you, along with the rest of the crypto industry, would really like a new tailored set of rules from the Securities Exchange Commission for crypto. But the flip side of that would be legislation from Congress. Are you talking with lawmakers on Capitol Hill right now about what we could see on the legislative front this year? Could we expect some sort of new regulatory framework for crypto this year?
I think we'll see significant action towards legislation this year. By the end of last Congress, which ended last December, there were probably 7 big important bills with bipartisan support in the House, the Senate, Democrats, Republicans, the Banking Committee, the Agriculture Committees, the House Financial Services Committees, all the relevant bodies, both sides of the aisle, both sides of the Capitol, are very much of a view that we need a regulation around crypto for crypto commodities, to create a spot market authority at the federal level for crypto securities, to essentially encourage the SEC to provide the clarity that it hasn't itself provided, and then for stable coins. And we expect from our conversations with policymakers that you'll see significant action towards legislation starting, almost immediately. Now, legislation is a hard thing to get done, but there's a lot of interest and motivation to get going on the process, and we think that's quite exciting.
And my thanks to Coinbase's Chief Policy Officer, Faryar Sherzad, for that interview. Now, separately, given all of the fallout that we're seeing from the bank failures and questions around executive compensation and bonuses, Rochelle, I'm just getting some breaking news in right now that the Biden administration is about to announce that they need Congress to draft legislation to strengthen their authorities on clawbacks and penalties for that. House Financial Services Committee ranking member Maxine Waters is drafting a letter in response that she's about to come out shortly with that she is working on legislation to give the administration those powers. Back to you.
Appreciate that breaking news there. Jennifer Schonberger there for us. All right, coming up, Moderna is facing pressure over its proposed COVID-19 vaccine price hike. Angelique Emlani is joined by the company's president next.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while. But then something happens in the housing market, the price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Kamlani. Moderna is facing pressure over its proposed COVID-19 vaccine price hike. Senator Bernie Sanders, the recently appointed chair of the Senate's Health, Education, Labor, and Pension Committee, wrote to the company's CEO early in January, where he called Moderna's plan to quadruple its price on the COVID vaccine to $130 per dose unacceptable corporate greed. Moderna's CEO is set to discuss the company's pricing strategy in Congress Wednesday. Joining now to discuss is Moderna President Stephen Hoge. Stephen, pleasure to see you again. It's been a while, and welcome back. I know there's a lot going on with regard to this price hike and what goes behind it. I know the company has already issued a statement clarifying that the vaccine will remain free to the general public, especially those who are insured. But fill us in on what's going on here. What's going on behind this price hike, and why? And what will CEO Stefan Bancel be telling Senator Sanders next Wednesday?
Yeah, of course. Well, Anjali, first, thank you for the opportunity to talk today. We're about to go through something almost as unprecedented as what we did over the last few years from a pandemic perspective, which is that we are for the first time moving from a pandemic government purchase market to trying to set up a commercial market with at least a couple of competitors, maybe three, and make sure the vaccine is still available across the country in all of the places and sites that it will need to be. This has literally never happened before. And so what we're trying to do as one of the many manufacturers in this space is pick a price that we think reflects the value of the vaccine, the value both to patients and healthcare systems and payers, and ultimately in terms of lives and costs saved, but that also reflects the complexity of moving from this pandemic market to a commercial market. Just to give you some sense of the challenges that we face. This past fall, when we were rolling out the vaccine through the public health emergency authorizations, when it was purchased by the United States government, we were delivering just to 3 warehouses. And the US government then took responsibility for distributing that vaccine into what was probably almost 60,000 different places, pharmacists and doctor offices where people would want to be able to walk in and get the vaccine they want when they want. And our responsibility now as we transition to a commercial market is we have to take responsibility for making sure we provide that vaccine and actually get it to all of those places. We're also transitioning from a world where the pandemic, the public health emergency will be ending. And I think everybody recognizes that during the pandemic, as a part of our commitment to public health, but also as a part of our sense of obligation to the United States government, the vaccine was sold as a substantial discount to the value that it was creating. In fact, if you look at health economic analyses that have come out, including in other countries, the value created in terms of health cost savings for everybody who receives the vaccines in the several $100s, $300 plus. And now what we're trying to do is come up with a responsible price that still makes sure everybody who wants it can get access to it, that does still create value for healthcare systems, but that allows us to step in and take responsibility for all that complexity of that commercial market going forward, including responsibility for distributing it to all those sites.
And let's look at what the numbers are, because I think that plays a key role in why Senator Sanders sent that letter. In particular, the fact that part of this is taxpayer money that went into the development of the vaccine. So, in the letter, he says that it only cost $2.85 to make the vaccine dose. Meanwhile, the company got $1.7 billion in federal funding and now is sitting on profits of $19 billion. All in the meantime, increasing the price to approximately $130 per dose. So clarify all of this for us. The fact that the company did in fact develop the vaccine with the help of the government and now is charging the same taxpayers a higher price as a result.
Right. Well, so let me start with just the government support and partnership, which we are grateful for. We did work with the U.S. government. Many companies did, and unfortunately, only ourselves who are working with the United States government were ultimately successful in bringing a vaccine forward, and at this stage are going to continue to commercialize it. Our interest in making sure that vaccine is still available in all those places. But during the pandemic, we actually were providing the vaccine at a substantial discount. If you just compare us, let's say, to the other mRNA vaccine, we in fact provided discounts during the pandemic that were $2.9 billion off of that price. And that's whether you compare it against the other vaccine or what was being charged internationally. And so in exchange for that $1.7 billion of support for the clinical development that we received, we have already actually provided $2.9 billion worth of discounts back relative to other vaccines that were being purchased at the same time. And so we do think we've paid that back and then some already as a result of the discounts that we offered over the last 2 to 3 years. Now, looking forward, we have to find a price that we think reflects the market for this product and also reflects the value it's going to be creating for healthcare systems. Just as a reference point, the influenza vaccine, the senior dose influenza vaccines are reimbursed by Medicare at about $70 right now. So $70 is a reference point for a seasonal flu vaccine. There was 3 times as much death and hospitalization and cost associated with COVID this past winter as there was with flu. And so as a reference point, we're actually probably in range. In fact, per dollar, per instance of death and hospitalization, actually probably a little bit lower than what's already happening with the seasonal flu vaccines. There are obviously other vaccines that are reimbursed up at $230, the pneumonia vaccine for pneumococcal infections. And so we think we're well within that range. Now, nobody's ever established a market like this before. And so there's a huge amount of work we have to do just to make sure the vaccines are available. Yeah. The last thing I'd point to through the references is that there's a huge amount of cost that was not present for companies, Moderna and others, in the public market that existed just 6 months ago. And just as an example, if you look at the doses that were being provided by the government to the government, we were providing 10-dose vials, so 10 doses in one glass vial. As we move to a commercial market, the expectation in your pharmacies and your doctor's offices is that we provide single dosage forms, single dose vials. That's 10 times more expensive, just because you need 10 times vials. And in addition to that, we're going to be providing and putting that vaccine out there into all of these sites from a distribution perspective, without guarantee that those doses will actually be administered. And again, if you look at the experience in this last fall, approximately 160 million doses were purchased by the government, but really, unfortunately, only 50 million were administered. And hopefully that number goes up in the coming years. But it just gives you a sense of the amount of excess supply that was created and needed to be put out there, but that ultimately didn't get put into arms. And going forward, Moderna will really only be compensated for injections in arms. So there's huge amounts of uncertainty as we try to establish a commercial market. We step in and take responsibility for this, ranging from the increased cost of the vials to the amount of returns that we might face to all the new distribution sites. And we've tried to reflect that as well in how we've gone forward with a responsible price.
Certainly it's going to be interesting to see how those numbers pan out, considering the low uptake that we have seen. Moderna President Stephen Hoge, thank you so much.
Thank you, Anjali.
Coming up, Silicon Valley Bank's collapse, now making it harder for startups to secure venture funding. PitchBook senior venture analyst Kyle Stanford outlines what's next for the VCs after the break.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account's going to fluctuate. SIPC insurance doesn't protect you against that. if you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Silicon Valley Bank was the leading lender and banking partner for many successful venture startups. With the bank's collapse, venture funding is becoming harder to access, especially as investors shift their focus to higher quality targets. Joining us now to discuss the outlook for venture activity in the wake of SVB's collapse is PitchBook Senior Venture Capital Analyst Kyle Stanford. Thank you for joining me this morning, Kyle. When you look at the evolution of what led up to SVB's collapse here, what do you think needs to happen now with VCs?
I think one thing that VCs really need to do is take a little bit extra precaution when they're making these investments. We saw a huge run up in deal value in 2021, obviously leading to Silicon Valley Bank taking on more deposits. We've seen a very, very fast and swift slide of that deal value in the market over the past 4 quarters. We had $34 billion invested in Q4. We're looking at probably a little bit less than that in Q1 2023. But what this, bank collapse is going to do, hopefully, is increase the due diligence process of the investors into these VC-backed startups, which is going to continue to slow that funding. It's going to make it more difficult for these companies to raise capital, even more difficult than it's already been.
So then where are some of these companies looking to go? Obviously, being that SVB was such a pillar in the venture community, where are some of these companies looking to go?
Sure. Right now, their options are to go back to those equity investors or to find a new lender, right? We've talked to a lot of lenders that, were in competition with Silicon Valley Bank or were later in the venture lifecycle. And they've had a huge number of inbounds over the past few quarters looking for more loans. What that's going to do is increase the, benchmarks for these companies to raise capital. It's going to be companies that are very strong, and it's going to really bifurcate the market and make it really difficult for companies that aren't as strong to raise capital, either equity or debt. Strong companies with strong balance sheets, lots of capital runway, are going to be able to raise from equity investors or lenders, depending on how they want to go, and continue to grow in this market.
And as you talk about that bifurcation, then who are going to be the winners and losers at the end of all this?
The winners are obviously going to be the companies that have a really strong standing, are able to continue growing market share, and continue to innovate in this economy. Again, when we talk about the amount of capital that came into the market over the past couple of years, there are some companies that are sitting on really strong cash balance sheets, and that's going to allow them to continue to grow without needing to re-enter the equity market into a much more formidable market than they last raised. Those companies are going to have an easy time continuing to grow, finding their niche, and really, exploding their customer base to continue to raise capital and be successful in VC.
And obviously, SVB being a regional bank, it somewhat understates the impact that it has, not even just in the US, but also beyond as well, not just for tech, health sciences, and in other dimensions. What do people really need to understand about the impact of SVB's collapse?
Well, I think one figure that really stands out is that they banked for somewhere around 50% of the tech and life sciences companies in the US. That's a huge number. And that, again, like you mentioned, does not include the Israeli startups, the India-based startups, startups around the globe that were banking with them. They had reached far into the venture market, really, obviously, increasing that exposure the market had to a single bank. But this was a bank not for Silicon Valley, even though its name might imply so. This was a bank for all startups around the world.
And so then as you look at the sell-off of some of these packaged assets, then what are your expectations there? And will that perhaps change as some of this calms down? Or is this something that we're going to continue to see some reverberations?
I think, this is going to be a long, drawn-out process. I think when we look at the loan book that they had of early-stage startups, that's really difficult for larger banks or other players looking to do diligence. It's hard for them to, put a price on those. The warrants that Silicon Valley Bank held, many of those companies are still private and have not yet been able to exit, and there's not really a good path for them. So this is going to be a long, drawn-out process, and that's going to increase the caution and pressure on the venture market. Again, this was a bank for not only VC or startups, but VCs, for executives at many of these companies. This is a really intertwined bank with the venture market, and that's going to make it a very long, difficult process for these for the market to kind of unwind itself from the bank.
And obviously, a lot of people looking perhaps for opportunities to buy, obviously seeing some of the struggles as some of these companies try and find ways to get more debt on board. So what do you think that means in terms of what it means for the broader market and perhaps interest we might see in M&A here?
Again, I think this, what we've seen, Credit Suisse taking out a large loan, First Republic trying to stave off a collapse. This is something that it was a kind of a harbinger for what was happening in the banking sector. Right, that's going to make everyone pause. It's going to, increase the, regulation and the kind of oversight on the broader market. And again, this is coming at a very bad time for not only VC, but in the broader, macroeconomic cycle. And we've seen public stocks take a hit for the past, year. And this only adds to the pressure and difficulty that the market will have to kind of come out the other side of the cycle.
Certainly, the timing couldn't be worse indeed. PitchBook senior venture analyst Kyle Stanford, thank you for joining me today. Well, a big day in court for Silicon Valley darling turned convict Theranos founder Elizabeth Holmes. A federal judge is set to make a ruling over Holmes' request to stay out of prison and how much she should repay the investors who sunk hundreds of millions of dollars into her blood testing company. Yahoo Finance's Alexis Keenan is here with the details. Hey, Alexis.
Hi, Rochelle. So yeah, this is a big stakes hearing for Elizabeth Holmes today. It's starting at 1 p.m. Eastern time, and it's to settle some post-trial matters that are still pending between the government and Holmes and her attorneys, and they stem from that fraud conviction that she had on 4 counts of corporate white-collar fraud back in January of 2022, and for which she was sentenced to 11 plus years in federal prison. Now, in this hearing, the judge is set to tackle 3 different disputes between the government and Holmes. The first is Elizabeth Holmes' request to stay out of prison pending an appeal of her convictions, and that appeal will go, as she says, to the Ninth Circuit Court of Appeals. She'd like to stay out of prison while that matter is handled, though the judge is not expected to go for that request. He has already denied a similar request from Holmes' co-defendant, Sunny Balwani. At the sentencing, the judge had ordered Elizabeth Holmes to surrender to prison on April 27th, so very soon here, and that was also taking into consideration that she was at the time waiting on the birth of her second child, which she has since given birth to. Now, second, the government is also going to have a request at this hearing, and it is requesting that Elizabeth Holmes pay back restitution. And what restitution is, it's basically paying back victims of fraud or of a crime. And so in this case, the government is asking for a whopping $887 million for Elizabeth to pay back victims, though the judge is expected to reduce that amount. He's already called the amount inherently suspect, and in calculating the actual amount that investors lost due to the counts on which Holmes was convicted, that number was about $120 million. So that 878 being quite a bit more there. Now, finally, also the judge will be considering a request from Elizabeth Holmes to block some information in court documents that is about whether or not she is a flight risk. Government prosecutors, they contend that she is, and therefore she should be sent to prison on her date of surrender. But Holmes wants to keep out some information that has to do with her purchase of a one-way plane ticket to Mexico that prosecutors say she only canceled her trip to go out of the country, which was prohibited under her bail conditions, after government prosecutors alerted her counsel that she had purchased that ticket. Now, the judge could rule from the bench today, or he could take these matters under consideration, but we will be bringing you the latest later this afternoon once that hearing does take place in San Jose, California, in federal court.
And Alexis, you mentioned Elizabeth Holmes' co-defendant and former boyfriend, Sunny Balwani, has skirted prison for now. What's happening with his case?
Yeah, so he is making a similar request to Holmes, although his request to remain out of prison pending an appeal of his case to the Ninth Circuit Court of Appeals It has already been considered by Judge Davila, and the judge in the district court there has rejected his request. However, there is an automatic right to remain free if you do ask the appellate court to stay out of prison while the court considers whether the matters that you're bringing to it are worthy of you staying out of incarceration. So he has filed kind of an 11th hour request to the appellate court. So for now, he was supposed to report to prison as of yesterday, but he remains out on this request that the appellate court is expected to take up, likely in short order. Rochelle?
Certainly lots of twists and turns still with this Theranos case. Alexis Keenan,
yet.
thank you there for that update. Indeed. Well, following the turmoil in the banking sector this week, penalties for senior bank executives in relation to institutions failing has been pulled into the spotlight. Here with the latest on what the White House had to say on the issue is Yahoo Finance's Jennifer Schonberger, here with the details. Jen?
Rochelle, this just in, President Biden calling on Congress to give regulators more authority to claw back executive compensation in the wake of that string of bank failures we have seen. The president saying in a statement just moments ago, quote, when banks fail due to mismanagement and excessive risk-taking, it should be easier for regulators to claw back compensation from executives, to impose civil penalties, and to ban executives from working in the banking industry again. Congress must act to impose tougher penalties for senior bank executives whose mismanagement contributed to their institutions failing. Now, I'm also getting word that House Financial Services ranking member Maxine Waters is drafting a letter now working on legislation to strengthen the administration and regulators' authorities. This, of course, coming after reports have surfaced that Silicon Valley Bank CEO Greg Becker sold stock and stock options to the tune of over $2 million just weeks before that bank failed. Back to you.
All right, thank you for that update. Jennifer Schonberger there for us. All right, let's get you a quick market check before we go. All three major indices still bouncing around the session lows of the day. Biggest selling off coming from the Dow, down 1.3% there, off more than 440 points. That'll do it for now. I'm Rochelle Akufa. I'll be back with you Monday at 11 a.m. Eastern. See you then.